kind of seeing everything rally.
Obviously, there's going to be some pullback.
Earnings are strong, but a lot of that strength is being driven primarily by tech.
We have to look through to the actual earnings and fundamentals.
We still see higher equity markets by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, tech stumbles, OpenAI fueling anxiety, reportedly falling short of growth expectations. As the diplomatic effort is stalling, Brent advancing for a 7th consecutive day. And the door opening for what could be Fed Chair Jay Powell's last decision, the two-day meeting begins later this morning.
All right, so Annmarie can go through the politics, and then we'll talk about how this is really going to be all about Jay Powell, his future, whether he'll stay on as a governor. I'm actually really interested in the economics, which no one else is right now, because the Bank of Japan just came out and had a 6-3 decision, which was split. And I thought that was really interesting and highlights just how much a stagflationary shock really put central banks in something of a quagmire. So does this Federal Reserve think of it that way? No one will be talking about that. Absolutely, that will be on the back burner, will not make the headlines. Instead, it will be the future of Jay Powell.
Well, it should be the future of Jay Powell, because we need to know, because not only is it just a matter of is it going to be some sort of shadow Fed chair if he sticks around and hovers around Kevin Warsh, but also if he does decide to leave, that opens up a governor's seat. And do we see someone like Steve Myron be able to stay on the Federal Reserve, or does he have to leave because Jay Powell wants to stay till 2028?
These are all questions we can explore throughout this morning. There's a few things in the equity market we need to touch on. Oracle down by close to 5%. Equity futures on the Nasdaq a little bit softer, lighter, negative. Why? This from the Wall Street Journal on OpenAI missing its own targets for users, for revenue growth, and the CFO. I'm going to read this paragraph verbatim for you. Sarah Fryer has told other company leaders that she is worried the company might not be able to pay for future computing contracts if revenue doesn't grow fast enough.
This is incredibly important because OpenAI was the linchpin behind almost $1 trillion or more than that at one point in infrastructure pledges to build out what they thought was going to be an ecosystem for the next great thing. Well, it turns out they're losing market share to Gemini in terms of defections for subscribers. They also have seen defections to Anthropic when it comes to coding and some of the more technical aspects of their business. And so suddenly this raises this issue not only for the likes of OpenAI, but also for SoftBank, also for CoreWeave, also for Oracle. And you see the shares of all of those companies down in the pre-market trading.
Tough week as well for the company because Elon Musk, of course, trial begins when it comes to OpenAI. So a tough week for Sam Altman. On top of that in the story, not just are they missing internal targets, and you have to think internal targets. You make those internal targets thinking you could clear that bar and maybe in more some. Also in the Wall Street Journal, the CFO has expressed reservations about its plans to go public by the end of this year because of what is going on internally.
This company, incidentally, just had the largest funding round in Silicon Valley history, $122 billion. A lot of investors have thrown a lot of money at this company.
What I find amazing is we're at record highs on the S&P 500. We're at record highs for the NASDAQ and the big tech chips. And we've seen NVIDIA gain more than $1 trillion of market capitalization in the past 4 weeks. And we are talking about the biggest potential black swan that people were saying earlier this year, which was what happens if OpenAI collapses? And there are hints of not it collapsing, but it's not going to fulfill its promise. And people are almost shrugging. A couple of companies have their shares down. But is this a bigger problem, or is this just sort of, well, it's too bad, but they'll pick it back up again?
Noise or signal? Equity futures this morning negative by 0.2% on the S&P. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer as AI fears drag stocks just a little bit lower. We'll speak to the U.S. Energy Secretary Chris Wright as pressure builds in the Middle East, and Samantha Darrell, Goldman Sachs, hiking her year-end crude forecast. We begin this hour with stocks pulling back as concerns over AI return. John Stoltzfus of Oppenheimer with the street's highest S&P 500 target, writing, avoid letting the noise and drama of day-to-day market activity obfuscate the intermediate and longer-term signal that can help stocks climb the proverbial wall of worry. John joins us now for more. John, good morning.
Good morning.
The OpenAI report in the Wall Street Journal, noise or signal?
I would say it's near-term signal, but you want to avoid the noise around it because it creates drama. Anytime you have an advancement in innovation like AI, you're going to have disappointments near-term. The question is, how do they get through that? Where are we headed? And I think that's very much what intermediate to long-term investors take advantage of at times like these.
Draw a distinction between the signal and the noise. Which component of that report coming into this morning is signal?
Well, I would have to say that signal is the fact that they didn't meet their own expectations. In essence, that's the signal. The noise is it's sort of like in a chicken coop when all of a sudden the dog comes out and grabs some eggs. Everybody goes crazy, and then in a few minutes the farmer comes out, he feeds the chickens, everything's all right, new eggs are laid. It's like life goes on.
I saw that you were coming up today, and I was so excited because I was thinking it's going to be a therapy session. We're all going to freak out and say all the potential worries. And you're going to tell us it's all going to be okay. The world goes on and markets go up. But I just wonder if this is highlighting a potential fragility as we're at record highs, and we're seeing moonshot gains in the tech stocks. We're seeing on track for the best monthly gain for the S&P 500 tech stocks going back to 2002.
Well, when I look at it this weekend, we were taking a look, and from March 30th of this year through the 27th, we've got the S&P's up 13%, Infotech is up 24.5%, communication services up 19.4%, consumer discretionary up 14%. But what a lot of that had to do was the hedge funds jumped in and did a play where they went long, and now they're probably going to go, some of them will go short, or they'll have to change their positions because they're highly leveraged. But the overall trend remains pretty well intact.
Wait, hold on a second. Yeah. Are you subtly saying that you expect a downdraft in some of these names and that it's near term, but longer term, you're still bullish, you're still John Stoltzfus?
Yeah, and I'd say, and that near term could be, the biggest thing is good news and bad news is discounted so quickly today versus when I started in 1983. It used to linger because when you read the Journal, it was a newspaper that was reporting news that was 2 to 3 days old as a result. Today, everything is instantaneous practically with the digitalization of news flow. And it's not only traders, but intermediate to long-term investors have learned how to discount good news and bad news. So, life's uncertain. Well, you can't do anything about it. Live with it. Embrace the uncertainty. I think that's what Steve Jobs said when they came out with the initial little iPod, that had music on it. It did. You got the selection that it decided upon. And I recall reading somewhere the shuffle, and it was embrace the uncertainty was sort of the pitch. And eventually they got it so you could program it and everything.
Well, we're in uncertain times right now when it comes to the Iran conflict. And based off the reporting from the New York Times, the Wall Street Journal yesterday, the president doesn't seem to be buying the Iranian proposal. How much could we continue to just grind higher with this impasse?
Well, I think the idea of grinding higher without interruptions would be unrealistic. But I do think the depth of a pullback here will probably be, I can just see the shorts coming at me right now, right? But it's like it would be relatively mild compared to what the drama would imply. What's the longer-term trend? AI is here. The technology genie comes out of the bottle. It never goes back in. It continues to morph going forward. And for all the uncertainty around it, it does appear that there's a lot of investment. There's a lot of smart people behind it.
That's why you like tech. I've got that. Yeah. But you also like discretionary.
Yeah.
And to Annmarie's point, we've not settled the issues in the Middle East, and Brent crude's back up to 111. WTI is just short of 199 this morning. Why is this a good environment for discretionary?
Well, for one thing, it's a very much disfavored sector. And with the U.S. Consumer, the tendency is whenever either interest rates are rising or there's an increase in unemployment numbers, automatically it's figured that the U.S. consumer stops shopping. In our experience, the U.S. consumer, when times are good, they spend like a sailor who'd been on a long tour of duty, suddenly finds they got shore leave. When times are tough, they buy private label, they buy used cars versus new cars. They suddenly buy used clothes and call them vintage clothes. And they keep rolling because in the U.S., the consumer judges their success in terms of their job choice and how they live, not only by what they can buy for themselves, but what they can buy for their loved ones.
You have to have been born here or lived here for a significant period of time to have a real appreciation for American culture and the structural bias to be pro-investment, pro-spend for the U.S. consumer?
This is a consumption-first economy. When you're feeling sad, you go buy. When you're feeling happy, you go buy. When it's a holiday, you go buy. All of the holidays have special holiday seasons, and you can go out. The inventory is in the stores 3 months in advance. At the same time, you do wonder whether there potentially is a lack of recognition of the fact that not only are oil prices higher, but longer-term oil price expectations are reaching the highest levels of the contract for December. And that suddenly changes the game. I mean, are we boiling the frog, at least on the margins in parts of the consumer sector?
I don't think we boil the frog. I don't think that's a nice thing to do. But the point is, related to that, you've got to figure that
would be upset.
This stuff, it's the tide comes in, the tide comes out. What you want to watch for, the tsunamis. That's what worries you, okay? But the tsunamis generally don't occur on a regular basis. Related to oil, just think of it. If John Kerry had succeeded in killing the traditional fossil fuel energy during the Biden administration, we'd be in trouble like Europe right now, in trouble like most of Asia. Instead, we have more oil. Our biggest problem is that oil is priced to the world price. So, even though we've got plenty of oil, it's like a lot more expensive at the pump, even though I have not owned an automobile since 1985. Because I live in the city.
John, it's good to see you. God love you. We love you. John Stoltzfus of Oppenheimer there on the bull case for this economy right now. Data's been good. Retail sales have been good. Jobless claims were low. But this economy is absolutely hated by consumers right now, based on, not their consumption trends, but based on what they're telling us about how they feel. So what are they doing? This one is something to watch. I'm not saying it's dreadful, it's going to be ugly for the next several months, the rest of this year, but something to watch. It came from Bank of America. Air travel has slowed substantially, falling below its 24 and 25 levels just in recent days. So this is a really recent trend. Certainly doesn't describe what things were looking like going into this war, but just over the past few days, things have softened just a bit.
Yeah, well, prices have gone up about 15 to 20%. If you try to book flights, you can experience that. And what also has happened is a lot of the airlines have reduced capacity in addition to try to increase their profits so that they are more profitable on the routes they do fly. So there is a baked-in decline in travel that was expected. And do we see this in other sectors as well?
That's a trend to watch. It is a trend, and we'll be talking about the airlines a few times throughout this morning. If you're just joining us, welcome to the programme. Equity futures negative by 0.25% on the S&P 500 with an update on stories worldwide this morning with your Bloomberg brief. Yahara Anand has more. Hey, Yahara.
Good morning, John. The White House says President Trump and his team are discussing Iran's latest peace offer. Iran is proposing reopening the Strait of Hormuz in exchange for the U.S. ending its blockade. Tehran wants to postpone negotiations over its nuclear program as well. The Bank of Japan holding steady, leaving its benchmark rate at 0.75%. The votes coming in split at 6 and 3, boosting the odds of a hike in June. BOJ Governor Ueda saying it is less likely the central bank will meet its outlook for the economy as the war in the Middle East clouds growth prospects. And pressure mounting for OpenAI. The Wall Street Journal reporting the company failed to meet its own goals for sales and weekly active users for ChatGPT. The shortfall is fueling internal fears that OpenAI may struggle to fund its massive AI infrastructure spending. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara later this hour. That story from the Journal just weighing on risk appetite a little bit this morning, weighing on single names like Oracle. That's down 4 to 5%. Equity futures, you'll notice the Nasdaq underperforming. It's not just the equity story on the tech side, also crude. Brent back to 111 on a 7-day winning streak. Up next, holding firm on Iran.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear.
So what is happening in the global energy market? Up next, we'll catch up with the U.S. Energy Secretary, Chris Wright, live from New York City this morning. Good morning. Live from New York City, welcome back to the programme. Here's the state of things, the scores this Tuesday morning. Good morning to you all. Equity futures declining, down by 0.25% on the S&P 500, following 2 days of gains and back-to-back all-time highs on the S&P 500. The tech trade starting to come undone just a little bit, but relative to the major gains we've seen, it's nothing. 18 days of gains for chip stocks, coming undone in yesterday's session over that period, a gain of almost 50%. Unreal. This morning, a weight to the tape. Let's talk about where it's coming from. The Nasdaq's down about 0.65%. Notable underperformance there. The why? You'll see names like Oracle trading a lot softer. The why? The Wall Street Journal. OpenAI reportedly falling short of its own goals, and they're committed to a lot of spend.
This is really problematic on several fronts. It depends on kind of nosebleed type of growth rates in order to justify the amount of spending that it has committed to, which is north of $1 trillion. And given the fact that it just had the most expensive funding round in the history of private companies of $110 billion. So again, it really underscores a question of how much, A, OpenAI has really driven a lot of the race to solidify some of the data center capacity, and B, whether they justify it with respect to what their output is or whether they're getting cannibalized from the likes of Gemini as well as Anthropic. Ultimately, you're seeing this on the margins at a couple of companies. Does it represent something bigger? I think that's really what people are looking for.
It's a 1-2 punch to risk appetite this morning. That's the first one. Here's the second. It's in the commodity market. Brent and WTI. Brent up for 7 consecutive days. Brent crude this morning, 111, and up another 3%.
This comes after the New York Times and Wall Street Journal talking about that the president, according to the Journal, is skeptical of Iran's offer. But then the New York Times is saying he's just not satisfied with the offer. And this does make sense because for Trump, really, the hardest red line has been Iran would not be able to get a nuclear weapon. So why, when the U.S. has this leverage in terms of the blockade, Kepler saying 12 to 22 days, they are not going to have enough availability of storage? I think that means that the president, why would he make a decision now? He'd wait.
Brent crude, 111.55. Under surveillance this morning, holding firm on Iran.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear.
Here's the latest this morning. Brent climbing back above 111 as President Trump weighs Iran's latest proposal to end the war. The Treasury Secretary Scott Bessent saying the U.S. blockade is forcing Iran's oil industry to shut, with gasoline shortages to follow. Joining us now to discuss, I'm very pleased to say, the U.S. Energy Secretary Chris Wright joins us for more. Mr. Secretary, you are in Croatia, I believe. We can talk about the relationship between the U.S. and Europe in just a moment. We have to lead with Iran this morning. Mr. Secretary, in your mind, how much storage capacity does Iran have left, and what's informing that conclusion at the moment?
Well, look, there's monitoring of storage tanks at Karg Island and around the nation of Iran. But, yeah, they don't have a huge amount of storage capacity, and they've got old reservoirs that are low pressure, which means it's much more destructive if they have to shut in their production.
Kepler, Mr. Secretary, is talking about 12 to 22 days left that Iran has in terms of storage before they have to shut in. Do you see the president making any sort of decision on Iran's proposal before that time period is up?
The president's focused on getting the right deal. That could be independent of their storage, but obviously that puts great heat on Iran. If we can get the right resolution, that could be tomorrow, that could be 2 weeks from now. But the key thing is the right resolution. Iran, and let me just put the context again, Iran has roughly 1,000 pounds of 60% enriched uranium. There's no commercial peaceful use for that. That's bomb material, and that's 10 days, 2 weeks tops to turn that into highly enriched uranium for bombs. So this is an existential crisis. I'm very proud of the president to stand up and put an end to Iran's efforts to get a nuclear bomb.
Well, so it doesn't sound like the president would take this off-ramp from Iran, which is reopening the Strait of Hormuz. Obviously, the U.S. blockade would have to end, and then kicking the can down the road when it comes to talks on nuclear.
Yes, again, the critical outcome here is that we end the ability for Iran to have a nuclear weapon. There's many ways that deal can be structured, but the compromise will not be made on the principle no nuclear-armed Iran.
We see gasoline prices on average rising again this morning. They're above $4 a gallon. You recently said the administration plans to do more to bring down U.S. gas prices. We saw the waiver on the Jones Act extended. What else are you thinking about?
When you also saw announcements on the EPA for blending requirements this summer that allows our refineries to produce a lot more gasoline. Unfortunately, a few states foolishly did not go along with it. So California is still going to have outrageously high gas prices. New York State, I don't know why, also did not go along with the federal regulations. But we're doing everything we can to increase refinery throughput. American oil production is at record high. American oil exports to our allies abroad are at record high. So look, we're going through a period of discomfort to solve a 47-year crisis. And gasoline prices are still $1 a gallon cheaper than they were during the middle of the Biden administration.
Well, I'm hearing that the administration is also considering an export ban on U.S. products. Is that accurate?
Absolutely not. Absolutely not. Look, here I am in Dubrovnik in Croatia signing multi-billion-dollar deals to sell American energy exports. That is the fastest growing export out of our country. We're selling American natural gas, American oil, American jet fuel, diesel, and gasoline all around the world. We're not going to stop those exports. We're going to grow those exports.
Secretary, how much are you trying to ameliorate some of the price considerations in traditional allies of the United States, as this does potentially drag on for a longer period of time? I mean, how much is cost a big part of some of these exports?
Yes, everyone understands, particularly over here in Central and Eastern Europe, people understand the existential threat from Iran. Everybody wants to see that the United States successful in ending Iran's nuclear weapon ambitions. Nobody likes, of course, high prices in the short term, but they understand increased American energy exports, increased energy addition policies, lean into more energy production. That's what President Trump is all about. We've got to get away from those Western European policies of intentionally making hydrocarbons expensive and energy subtraction policies. The future of Europe, the dynamic growth of Europe, is going to be in these Central and Eastern European nations that lean into President Trump's American agenda of more energy, more economic growth, more opportunities for citizens.
Annmarie was alluding to this idea of potentially having restrictions on exports. And this has been deployed before, in part because prices were going up and it increased the price when we were exporting a significant part of resources in the United States. How do you plan to have exports continue to increase to U.S. allies while not necessarily having the ramifications of much higher prices here?
Because the refinery capacity we have in the United States now is greater than all of the consumption in the United States. If we didn't export our diesel and jet fuel, we'd have to turn down our refineries. Who would want to turn down their refining capacity in today's world? We want them, the higher utilization they run, the higher throughput they run on, the more efficient they are. They produce more products. That puts a downward pressure on prices, not just in the United States, but for everyone abroad. That's what America is about, bringing more energy to the world and pushing prices down.
Mr. Secretary, and you're announcing today Trump peace pipelines. Will it be something that all of our allies in Europe can get a handle of?
Absolutely. This Trump peace pipeline agenda is to grow the connection between the nations of Europe. Where I'm standing right here in Croatia, these nations were at the end of Russian Soviet Union energy system. They were at the behest, they were beholden to Russia. That's not a good place to be. What we're doing here is expanding this pipeline network so they can import oil and natural gas from the United States and then transport it among the nations in this region so their economies can grow and they can realize lower prices for their citizens and greater economic futures. I think the idea of the Trump peace pipelines, there's many of these, huge. We'll announce today a couple of historic agreements in this regard.
Mr. Secretary, I know you've got a tight window this morning, so thanks for making time for us. The US Energy Secretary there, Chris Wright, on the situation for global energy and US energy doing a ton of heavy lifting.
The U.S. is almost an exporter for the first time ever. And this is as a result of all of those exports that have been accelerating to meet the demand that has been left from the lack of oil supply in the region.
Up next, we've got some new targets over at Goldman Sachs. They're looking for $90 crude on average for the fourth quarter. We'll talk to Samantha Darrell at Goldman Sachs in just a moment. Live from New York City, you're watching Bloomberg TV. Coming off the back of 2 days of gains on the S&P 500, back-to-back all-time highs and pulling back just a little bit on the S&P this morning. We're down by 0.2%. On the Nasdaq, we're down by 0.6. A big OpenAI theme in the equity market this morning. We'll spend some time on that later. I just want to sit on the risk in the Middle East and just go through some numbers for you. So that's the equity picture. Here's the commodity story this morning. Brent and WTI. Brent crude, 7 days of gains, 111, up by close to 3%. Approaching the closing high since this war started. The closing high was around 118, so not too far away. So retesting those highs or getting close-ish to doing so. Likewise in the bond market, by the way. This is important. 30s, just 1 basis point away from the closing high. And the closing high in the bond market for yields was only 3 days before the closing low for the equity market. So this is a strange dynamic at the moment. So let's work through it. You've got bond yields retesting the highs of the year. You've got crude doing the same. Almost, not too far away, and you've got equities 13% off the lows on the S&P 500. Equities very disconnected away from this story.
Yeah, and in particular, the technology stocks, which have been on an absolute tear, their best month going back to 2002 right now, if we hold these gains where they are. Is this a situation of people closing their eyes to the reality, or is this a situation where the U.S. consumer can keep diverging from the rest of the world? This is the question that Stuart Kaiser addressed yesterday in a note where he was saying oil prices may reach a tipping point from a long-term blockade. He said the catalyst for that case is simply time. And that ultimately is what we keep looking at. What's the tipping point for this equity market to pay attention?
Well, it's not the earnings story just yet. Just got these numbers from General Motors. EPS for the first quarter, adjusted EPS came at 370. The estimate was 260. The full year outlook now for adjusted EPS, they offer a range of 11.50 to 13.50. They had seen 11 to 13. So I see that as a beat and a raise, Bramo, from General Motors.
Yeah, and some of the headwinds, like tariff costs, actually coming in much lighter than previously expected at $2.5 billion versus the $3.5 billion expected. But what this really does show is ongoing resilience and profitability, even with a slight miss when it comes to vehicle sales in the first quarter. Nonetheless, it's UPS, it's a lending club from yesterday. It's pretty much all of these consumer-facing names that we keep seeing that also are outperforming in tandem with the tech stocks.
The stock is up at a pre-market by 1.3%. In the next hour, we'll catch up with the CFO, Paul Jacobson of General Motors. Looking forward to that conversation as those numbers come in better than expected. Let's get you some more single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. CoreWeave, Oracle, and AMD all getting dragged down lower by that Wall Street Journal report that OpenAI missed some of its own sales and growth targets, raising questions about whether it can keep up with its massive AI spend. And that matters for this group because Oracle and CoreWeave, of course, are right at the center of the AI build-out. Both have deals with OpenAI, and AMD is locked into a massive partnership with OpenAI on the chip side. Speaking of chips, that record run we had in the chip sector has come to an end after yesterday. We were not able to notch a 19th straight day of gains on the Philadelphia Semiconductor Index. And we're seeing some weakness again today. Some of that may be having to do with that Wall Street Journal report on OpenAI. SanDisk falling 2.25% in the pre-market. But make no mistake, that stock has been on a tear, up more than 350% year to date. And we end on Bed Bath & Beyond, those shares soaring nearly 35% in the pre-market after it topped revenue estimates and posted a narrower than expected loss. But what's really driving this move is the company just delivered its first meaningful revenue growth in 19 quarters. John.
Yahira, thank you. That word resilience coming up repeatedly this morning in the equity market with regards to earnings. General Motors, Kimberly-Clark as well. Kimberly-Clark with decent numbers this morning, a beat from them too. Resilience across the board.
I'm not sure if Kimberly-Clark, though, is going to be necessarily a positive signal or a forward-leading signal, because we keep talking about whether this is going to be a pandemic-related shock. And ultimately, I've actually been spending some time trying to find out if there's a toilet paper index to see if maybe the price has been going up, to see if perhaps that's a forward indicator of people preparing for supply chain disruption.
At least one of the households around this table, very long huggies at the moment. So
Aww, that's so cute.
No doubt supporting that name.
Well, you know, that's a good thing to be long.
On our radar this morning, President Donald Trump telling advisors he's not satisfied with Iran's latest proposal to reopen the Strait of Hormuz. The administration previously insisting any deal must include strict curbs to Tehran's nuclear program. Elsewhere, the Bank of Japan holding its benchmark interest rate steady. The split vote boosting the chance for rate hike in June. The Fed set to announce its decision tomorrow, followed by the Bank of England and ECB coming up on Thursday. And finally, one of our top stories this morning, OpenAI failing to meet its own goals for new user acquisition and sales, fueling fear fears over its AI spending. The Wall Street Journal reporting that CFO Sarah Frier is concerned that the company may not be able to afford future computing needs.
Let's talk about what those spending commitments are. $1.4 trillion in AI infrastructure. That's how much OpenAI has committed to over the past couple of years. They've increasingly gone out to customers, to clients, to a lot of funds saying, please give us money. And plenty of them have, although Microsoft may be backing away from some of the terms. SoftBank recently committed $30 billion to the latest round of funding. And now you see SoftBank getting hammered. So again, we were talking about circular financing. OpenAI was at the center of a lot of it. And all of a sudden, it's losing share to the likes of Gemini and the likes of Anthropic. Is this signal, as you said, or is this noise? Increasingly, right now, it's being treated as more noise than signal because it isn't having a broader, huge response in markets, just a couple of select names. That said, does this indicate that it's a sort of set pool of customers and it's people cannibalizing for one another?
Does the capital expenditure now, do these deals potentially go on the sidelines, or do they just go to Anthropic and Google Gemini, which seem to be eating OpenAI's lunch? I still can't believe they set an internal bar and weren't able to clear it internally. And now the CFO, according to the Wall Street Journal, is actually concerned about whether or not they can make their IPO target this year as well.
Taking down Oracle, taking down the equity market just a little bit, explaining the underperformance in the NASDAQ so far this morning. That's one of the big market drivers this morning. This is the other one. Crude climbing to a 3-week high, with naval blockades keeping traffic through the Persian Gulf near zero. Samantha of Goldman Sachs hiking her fourth quarter forecast for Brent and WTI, writing, "We now assume a normalization in Gulf exports by the end of June. The economic risks are larger than our base case alone," suggests. Samantha joins us now for more. Sam, good morning. You just followed, I'm sure, our conversation with the Energy Secretary just moments ago. What's your understanding of how close we are to breaching storage capacity in Iran?
Yeah, it's hard to say. Data is not transparent, but it's important to remember that Iran has gone through extended periods of time in the past with very low production. So it's not obvious that this alone is a binding condition for something to really change fundamentally here.
Can they outlast us? That seems to be the question lots of people are talking about. We've had a severe inventory drawdown. You and the team have been crunching the numbers. How sustainable is that inventory drawdown? Because that's really supported things globally. It's kept a lid on prices to some extent. This would have been a whole lot worse.
Yeah, we'll find out. I mean, we're literally in unprecedented territory here. Even if things are normalized starting today, global inventories are likely to just dip below the historical lows. So we will find out how comfortable markets are with that, because the issue is we have these global numbers, but the reality, the physical reality, is a bit more heterogeneous than that. And some places might look tighter than other places. I think at the end of the day, the issue is a physical one. And right now, the way that this shows up in the headlines the most is thousands of flights canceled. And that seems a little bit like discretionary demand being impacted. Seems like an inconvenience. I think things will get more visible and potentially more serious when we have a real shortage on the chemical production side, because chemical products are used in 95% of all manufactured products.
Well, this is actually the key point that a number of analysts have made, and I'm curious to speak with the GM CFO to see if they're trying to stockpile ahead of any kind of lack of, whether it's chips or other supplies that they need to come into their cars. I mean, how close do you think that we are to that?
I think we're about a month away from running out a lot of feedstock supply for chemical companies, and probably 2 to 3 months away of running out of chemical products in a lot of regions that produce it. At least this is what we've been hearing from industrial users. And sometimes these industrial users are sitting, let's say, in Europe, but their chemical supplier is in Asia. And what they're telling us is our supplier called us and they said they have 2 months of supply. And after that, we have to cut back our own production. So this is how things can get more into broader supply chains.
So we were talking earlier about how the longer this goes on, the longer it takes to restart everything, whether it's production and whether it's just getting the ships onto the sea so that they can make their deliveries. How quickly, let's say it ended today, let's say the Strait of Hormuz was open fully, no constraints, how long would it take to restart some of those supply chains to avoid what you just laid out?
Yeah, so on the chemical side in particular, what we hear from our analysts for the region is that we haven't had a lot of infrastructure damage, which is good news. On the oil side, we go back to a pressure issue. The longer you stay shut down, if you're not actively investing in your infrastructure, your pressure is not going to be that great. So when you try to restart, your volumes just are slower to normalize. This, we think, is the case more with Iraq, whereas Saudi is going to ramp up, I think, more quickly.
When it comes to U.S. policy risk, you say it's not your base case, but you don't rule out an export ban. The energy secretary has been emphatic. He said absolutely not, that they are studying that. Is he going to basically regret those words maybe into the midterms?
It's hard to say. When prices go up, political pressure grows. And when we look at the differential between TI and Brent, it still suggests that the market does assign a probability, a non-zero probability of that happening. So we don't think it happens in our base case because it's not obvious that it helps. If you curtail exports out of the U.S., the margins for the refineries in the U.S. are going to drop. So it's not even clear how much product they will put out in the market. So are products in the U.S. going to get cheaper or more expensive because we're not producing enough of it?
What policies would help? We saw the extension of the waiver for the Jones Act, which is definitely helping New York, maybe California. Will they hit the SPR again?
I think that would help. More SPR releases, it does help moderate the pace at which inventories are drawing down. And I think right now, this matters more than it did, say, a month ago, because a month ago, we had a lot of oil stocked up on water, so you could draw down from that. That's now pretty much gone. So now you're drawing from storage on land. So it becomes a lot more visible, and if you're a refinery trying to buy that oil right then and there, it's scarcer. So more SPR releases, I think, would help.
This is a moving story. I just want to finish on this. When you say things like, we now assume a normalization of Gulf exports by the end of June, what informs that base case for you? When you look at the calendar, where's that coming from?
Yeah, I think a lot of that comes from the developments we've seen towards, say, a ceasefire, and a headline just not long ago, now it seems like longer, but not long ago, saying the strait is completely open. Okay, just to be closed the next day. But these headlines, what they signal to us is that there is a desire, there is an intention to end this thing. It's not helping either side. So that intention, and I think this is what keeping risk premium in broader markets limited to some extent as well. But that intention shows that they want to resolve it.
Samantha, it's good to see you. Thank you. Samantha down there of Goldman Sachs. That's helping the forward look a little bit better than expected. It's doing nothing to alleviate the concern in the here and now when it comes to clearing supply and demand.
Yeah, and I keep thinking about what Halima Croft of RBC had to say, which is that the fact that it's keeping control over the long end of the oil curve is actually creating more of a problem for the front end of the curve, because you're not seeing demand destruction that you normally would see if prices were significantly higher. So the normal reaction function in pricing just isn't happening, leading to more demand, which only increases the front end pressure. So this really is a difficult, and that's why I keep going back to boiling the frog. It's not very nice, but it does feel a little bit like that.
Brent Crude, 111.20. We're up by close to 3% this morning. Let's give an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. We are seeing GM shares rising nearly 4% in the pre-market. The company reporting first quarter earnings that beat analyst estimates. GM also raising its full year guidance following the Supreme Court's decision to strike down President Trump's tariffs. Coming up at 7:30 a.m. Eastern, GM CFO Paul Jacobson will be joining John, Lisa, and Annmarie. Meanwhile, shares of BP also rising, up 3% in London after its first quarter earnings far exceeded estimates. A surge in oil prices and market turmoil caused by the Iran war led net income to more than double. And the DOJ charging a California man with trying to kill President Trump over the weekend, the 31-year-old making his first appearance in federal court, where he was also charged with gun offenses. The suspect sent a manifesto to family members that was included in the charging documents. That's your Bloomberg Brief. John.
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, supply chains under pressure.
There may be some fits and starts and some quick answers that could be delivered. But once the strait is open, there is a lot of work to do in this supply chain. More than likely, what we'll see is a reset at some point.
Up next, we'll catch up with Brandon Oglenski of Barclays from New York City this morning. Good morning. You're watching Bloomberg TV. Just eyeballing this, you'll notice the gap between the S&P and the Nasdaq and the underperformance you're seeing on the Nasdaq 100 this morning. The Nasdaq is softer, lower negative by 0.75%. The Wall Street Journal out with a report on OpenAI this morning, indicating they're falling short of their own targets. So that's weighing on some of the companies exposed to that in public markets, the likes of Oracle.
And this was the existential threat earlier this year. What if OpenAI isn't the next big thing, and you have all of these big companies that have invested so much in it? Is this the first sign that that's the case? Ultimately, we'll have to see. But right now, you can see the companies that are closest to it seeing the biggest declines.
And that's weighing on tech this morning. Oracle's down by more than 5%. This is weighing on risk appetite as well. Crude up again. Brent, 7 days of gains, 111.21. Under surveillance this morning. Supply chains under pressure.
For every 1 day of service disruption, it takes about 3 days to catch up. There may be some fits and starts and some quick answers that could be delivered. But once the strait is open, there is a lot of work to do in the supply chain. It will take some time to get these products moving in and out.
So here's the latest this morning. UPS shares falling in the pre-market, down 3%. The company leaving its full-year guidance unchanged, even after reporting first-quarter earnings that beat estimates. Joining us now is Brandon Oglenski of Barclays. Brandon, good morning.
Good morning, John.
Good to see you. The word that's come up repeatedly through earnings season is resilience. Do you see that with UPS this morning?
Well, and John, we've seen actually other freight companies already report, and we're seeing a little bit of a positive inflection across not just the consumer supply chain, but importantly, the industrial supply chain. Unfortunately for UPS, though, they're dealing with something structural within their own business, which is Amazon, which was a 20% customer of their domestic network even a year and a half ago, decided effectively to take half of that business and insource it into their network. So they're still dealing with those volume declines. I think they're losing another 5 points of volume through June or July of this year.
Some might call that idiosyncratic. How does the situation in Iran right now, fuel costs, etc., fold into what we're seeing on the screen this morning?
Well, for sure, what UPS and FedEx, because there's a lot of fuel surcharge revenue here, and actually we think that revenue probably exceeds the incremental fuel expense. So there's a lot of pricing tailwinds. And for sure, UPS's goal here to get rid of some of this Amazon traffic is to increase mix, increase yield, and hopefully turn the page on margins longer term. But unfortunately, there's friction in all this, and they are a unionized network. They tried to get rid of, I believe, 10,000 drivers, and effectively the Teamsters sued them. They came to an agreement with the union that said, maybe we'll let fewer drivers go on this buyout program that they had. So there's just a lot of challenges when you try to shrink these time-definite networks, especially when you're a unionized business like UPS.
Is there a signal in the fact that UPS has increasingly leaned on the lever of layoffs to try to increase margins, to either shrink capacity or just sort of right size to a market that now has a much greater degree of competition?
Well, and that's precisely what's going on here. I mean, you have the highest cost network is UPS, probably the least flexible labor, just because they have the union contract and all the work rules. And we're not anti-union by any measure, but FedEx has effectively an independent contractor network. Amazon really replicated that in the last 5 to 10 years. So you have Amazon insourcing, which is UPS's largest customer, and you have FedEx that's lower cost and arguably higher service right now than UPS. And I think their only answer is, can we retreat to a core base of business-to-business revenue and small and medium business shippers that maybe pay a little bit more where we can derive that margin? But the problem is, as you shrink the business, your fixed costs don't go down as fast. So you ask for more price from your customers, and your customers say, well, there's alternatives. I can use FedEx.
So this might be more of a structural, idiosyncratic, maybe, type of situation based on the fact that it has a high union membership and it has serious competition. On a broader macro level, some of the airlines have come out and either reduced their guide for the full year, given a sense that they expect demand to really drop off. Some initial indications, as John was mentioning earlier, that that's actually happening. What do you see in terms of how much consumer demand really is responding to those higher prices?
Well, I know there's a lot of credit card data out there. Our competitor banks publish on that. But I think the most recent that we've heard from all the airlines is actually things are getting stronger as we progress through April and into peak summer travel months. So I'm not sure that we're seeing significant slowdown in the consumer yet. In fact, I think that's been accelerating. This was probably the first that we've heard any inklings that things are slowing.
Yeah.
And the airline guide's coming down. That's really from an earnings perspective because fuel is such a significant portion of their cost structure, going from like 30 to 40% of cost. So you're definitely going to see negative earnings revisions. Importantly, though, the revenue revisions have been very positive, I'd argue.
You mentioned that last time we caught up, that things are getting better.
Yes.
Not worse through this war. Is that just a pricing story, or is there something else happening here?
Well, I mean, we're firmly of the belief that the consumer's been on solid footing. It wasn't shocking to us that retail sales surprised because we can see it again maybe more in real time with airline spending. And in fact, FedEx beat estimates last quarter. Most other freight transport names are beating estimates. So I know everyone looks at UPS as kind of the bellwether, like, oh, they're one of the largest transports out there. But unfortunately, again, they're going through this very difficult process of trying to shrink their business.
Can I ask you something that Lisa's talked about a few times over the last several months? Do you think the situation in the Middle East is actually dampening what could have been a boom in this economy at this point?
Absolutely. As a transport and airline analyst, I feel like there's been something every year here where we constantly are resetting numbers lower. This was setting up to be a very big year, I think, of earnings for across our sectors. But if anything, I think markets are reacting because you look at most of our stocks, maybe apart from some of the smaller airlines, we're in line with the S&P, if not even outperforming, especially on the freight side.
But jet fuel and diesel are going up tremendously. At some point, will it hit?
I think that is the fear, that if this is a prolonged duration event, and again, we don't have any agreement, I think, between the parties right now, right? So
we do not.
If this is prolonged, then we could see demand destruction for sure, because this is an input cost, to a lot of the supply chain. And
that changes from hour to hour, though, and I haven't seen the latest Axios report, which usually drops around now, about 90 minutes before the cash open.
Well, it's true, but also, from my thinking, if Kepler's reporting that Iran is 12 to 22 days before they hit maximum storage capacity and they have to have shut-ins, that's basically how much longer I think this blockade and the closure of Strait of Hormuz last. Because why would Trump make a move until Iran feels the maximum economic pressure?
Brandon, just quickly on jet fuel.
Yep.
The transatlantic London-New York corridor, Lisa's talked about this so much just in the last week when catching up with the likes of United Airlines. How close are we to these airlines needing to make some tough decisions about the kind of routes they can do and the kind they can't?
Well, again, I think we talked about this last week, too. At least from a U.S. carrier perspective, no one's really worried about the availability of jet fuel, even looking through peak summer operations. I think the concern is going to be what is the price that we're paying.
They can get to London. I'm just wondering if they can get back.
I think the concern is more in Eastern Europe and supply shortages there. But, we've heard from some European carriers saying that this is a little bit overblown at the moment. So we have to wait and see.
Brandon, it's good to see you.
Thank you,
buddy, as always, for an update. Brandon Oglenski there of Barclays. Lufthansa, the first one out with some big numbers, and you wonder if that was masking some other choices they were trying to make over in Germany.
The bottom line is, short flights are not that profitable, right? Those commuter flights to big cities.
They're the ones that are gone.
They're the ones that are gone, and they're the ones that really just can't justify themselves in terms of the cost. And those are going to be the first to go all around the world. The highest margin flights are the international ones, particularly the transatlantic ones. Those are not going to go anywhere because that will maintain a lot of the profitability of the airline. So this might be a sort of rationalization of some of the routes and exactly what actually pays the bills.
Dampening what could have been a boom.
100%.
This has been your theme. It's kind of the story, looking at the data and the earnings.
If you see the reacceleration of consumer spending, and this is what people were talking about with the one big beautiful bill, we said, really, isn't that baked in? Well, maybe not. And actually, we're seeing that come to fruition. But there always seems to be hair on it, doesn't it? And right now, there's a pretty big suppressor.
Up next on the programme, Darrell Cronk of Wells Fargo, General Karen Gibson of Academy Securities, GM CFO Paul Jacobson, and Seth Carpenter of Morgan Stanley. The second hour of Bloomberg Surveillance just around the corner.
There are questions around the direction of economic travel.
The market recognizes there's going to be an inflation problem.
You can't cut rates in a rising inflation environment.
Clearly, the shift has been to a wait-and-see mode.
I'm not calling for more Fed rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores, the price action, looks like this. Following back-to-back all-time highs on the S&P 500, pulling back by 0.2%. Underperformance on the Nasdaq 100, down by 0.6. Underperformance for some single names, including Oracle, down by 4 to 5% in the pre-market. Following this, from the Wall Street Journal, OpenAI missing its own targets for users, for revenue. The CFO telling other company leaders she's worried about the company and their ability to pay for future computing contracts if revenue isn't growing fast enough.
This is potentially a massive story for the entire tech complex, given the fact that OpenAI has committed to spending about $1.4 trillion on infrastructure projects tied to data centers and beyond, financed by all sorts of tech companies and investors who are adjacent. Does this indicate just simply a cooling of demand or just fierce competition, or is there something bigger here that indicates that OpenAI and the hopes and dreams and all of the money that went into it might have been a little bit overblown?
All these tech companies that have partnerships with OpenAI should be asked this on the earnings call this week, and hopefully we'll find out what they think about the future of OpenAI, which according to the Wall Street Journal is losing ground when it comes to Anthropic as well as Google Gemini, so much that they're concerned about the IPO maybe being on ice this year.
The AI story was a pillar of support for this equity market since the lows of the end of last month. We've had a 13% rally off the lows on the S&P 500. The headwind is coming from crude. It's still coming this morning. Brent's up for a 7th consecutive session. Brent crude this morning topping 111, higher by almost 3%. There is no deal in the Middle East. There is hardly any traffic going through the Strait of Hormuz, and the tension is just building day by day, day by day.
And I know that the first thing, or one of the first things that you do and I do in the morning, is take a look at the December contract for Brent, and you can see that it's at the highest level so far on record for this contract at north of $87. People aren't just looking at this as a near-term issue. People are extending the time frame slowly and slowly and slowly. And at what point will it hit the U.S. economy? It's hitting other areas. But this is sort of the disconnect that people feel. Could this be a real supply chain shock akin to what we saw in 2020 that the market just hasn't wrapped its head around yet?
Trump could have potentially taken this off-ramp from the Iranians, which is reopen the Strait of Hormuz, but kick the can down the road when it comes to what is going on with Iran's nuclear ambitions. And it doesn't sound like the president wants to take that, because that is the hardest of his red lines. So he's unwilling to take the opening of the Strait of Hormuz if it means that Iran basically has a win when it comes to nuclear, which is why you see oil prices moving up. And this is going to get a lot harder for Iran in the next 3 weeks. This data from Kepler is key. 12 to 22 days, they are going to hit tank tops, and there's going to be nowhere else for this crude to go.
Let's break up the market, individual asset classes. Let's start with commodities. Abramowicz said it, long-dated contracts making new highs. Check out the bond market, really stealthy stuff, not being talked about enough. We're looking at retesting new highs for the year as well on 30s, so at the long end of the US curve, on 10s in Germany, on 10s in the UK. They've got their own problems, I know. But you're starting to see that retest again in yields, in fixed income, just as you see those new highs coming into crude. At the same time, equities are 13% off the lows. We've had a 13% rally off the lows on the S&P 500. Why? It's hard to fight the earnings story. When you look at the names coming out this morning, GM, Kimberly-Clark, Coca-Cola, just moments ago.
Yeah, and this is just the highlights. This highlights how multifaceted this earnings boom really has been. We talked about the tech giants and how they're expected to outperform. Coca-Cola just raising their full year forecast for earnings based on the fact that they're seeing strength in things like their concentrate sales. They have, of course, CapEx that actually is exceeding expectations. So the CapEx boom, they're underway. Seeing demand just continue, even though people are worried about the consumer spending backdrop. So, we could be gloom and doom, but then these companies come out and they seem like things are going really well, given the fact that one after the other is beating forecasts.
Coca-Cola higher by 2.3% so far in the pre-market. Equity futures negative by around 0.2% on the S&P. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo as OpenAI fuels some anxiety in the tech sector. We'll speak to General Karen Gibson of Academy Securities as President Trump considers Iran's latest offer, and the General Motors CFO, Paul Jacobson, as the automaker posts an earnings beat. We begin this out with stocks pulling back ahead of tomorrow's tech earnings. Darrell Cronk of Wells Fargo writing 5 of the Mag 7 report this week and will set the tone for the balance of the Q1 reporting season and overall market direction in the near term. Darrell joins us now for more. Darrell, welcome to the program. We heard from the Wall Street Journal earlier on this morning indicating that OpenAI are falling short of their own sales targets, their own growth targets. Darrell, is this a house of cards, and who's exposed?
Well, good morning, John. No, I don't think it's a house of cards at all. In fact, when you look at people are trying to figure out why such an explosive rally in the month of April, all you have to do is look at tech and financials being 45% of the market cap, almost half of the entire index from a market cap weighting standpoint. And tech earnings are growing at 35% for this quarter. And financial earnings, which doesn't get the same press that it probably should, are growing at 22% this quarter, right? So even though we know the quarter is going to be mid double digits, call it 15%, with an average beat ratio probably pushes you closer to 17, 18%, It's not a house of cards. But to the point, right? I think what the markets are watching intricately and closely is you don't need to see a deceleration in CapEx expectations coming from those big private companies or even the public companies. You just need to see indications that, well, maybe that trend has peaked. And if it's peaked, I think then you start to reprice some of the models about what you can expect going forward.
So, Darrell, let's break this up because this is important. Let's start with tech. Let's just park financials and what's happening in the bond market just for a moment. I want to come back to that. But just for tech alone, let's say you don't see that continued acceleration in CapEx from the big spenders, and we see more sign of that perhaps later this week. I don't know, but we'll look out for that tomorrow afternoon. What does that mean for how this market is priced? The moves we've seen in chips, in semis over the past 3 weeks?
Yeah, I think it might have. We might be a little bit overbought here. So we actually came on the show about a month ago. At the same time, beginning of April, we upgraded tech to an overweight. We had downgraded it last October. It had traded sideways, upgraded it, and took the money out of energy because we just thought the energy stocks had gone too far, too fast, unsustainable. That's just been one heck of a trade, a high convexity trade in the month of April. To us now, it looks like they're a little bit ahead of themselves, right? I don't really see a sustainable trend, though, John, yet that we'll see that peak of CapEx and, it's starting to roll over. What I would say, and what's interesting, is if you look at the numbers on like engineering and construction backlogs, they're starting to build, right? So the choke point here may not be the tech companies and all those wheelbarrows of cash and willingness to spend. It may be, in fact, how fast we can actually monetize and build those data centers and everything else because of things like engineering and construction backlogs, or because not getting the energy needed to power them, all the kind of things that could become actually down the road choke points.
Darrell, how much of this was independent of what we're seeing in the Middle East, and how much do you expect some of these big tech companies to talk about how that's adding to some of these frictions and the time that it takes to build some of ththese data centers and beyond?
Yeah, I think that's real, Lisa. I mean, obviously it adds to the whole mix I just talked about. I mean, it's interesting when you talk to the energy companies, like the refiners and some of the export companies, they will tell you in the physical market, getting access to physical oil is much more expensive today than even the financial markets print. So we're talking about this morning, the spread between WTI and Brent crude. It's back at $10 basically, which suggests that there's stress and low shortages or low inventory out on the global floating marketplace, right? But if you talk to actual refiners, they're telling you, I have to pay way above even what Brent prices are to get the physical oil into the refineries to start to move it through the ecosystem. And I think that's what's got to catch up. There's a little bit of complacency. You've been highlighting it all morning, Lisa. Complacency in that forward market, just like there's a little bit of complacency near term in the equity markets about all of this gets resolved, all of it moves to the sidelines quietly, nicely, and easily. By mid-May here, in about 3-4 weeks, you're going to start to see some material demand destruction that could push, and I emphasize the word could push oil prices back to something like 120, 125, 130, 135. That's not out of the cards if we don't get this strait reopened.
Darrell, there are a lot of different markets that are kind of intersecting to create the stability and resilience that we've seen over the past couple of years. You say that we're probably a bit overbought here. Jonathan Krinsky was saying that in the tech sector, when things go parabolic, like they have in semiconductors in particular, they tend to retrace with similar vigor. Are you looking at that type of retracement in the weeks and months ahead, or are you looking at just sort of a deflating of the balloon?
Yeah, I don't think you're going to get into any long-term sustainable trend. We didn't downgrade tech, to be clear, right? We just think the positioning got a little euphoric. Obviously, it's been led by those 18 straight days of semiconductor stock outperformance. But what's interesting is you get underneath the surface in tech, and tech breadth is broadening across the sector. We all know what was the trade here kind of 30 days ago, which was long semis and hardware, short software, right? That has kind of flipped, and some of the software names have come back and started participating, which I think has been really key to this tech rally, right? Yes, it's led by semis and hardware, but it's not exclusively semis and hardware like it was maybe 2, 3, 4 weeks ago. So you could get some moderation, but I don't look for any sustainable downtrend unless something breaks here, and I don't see what's going to break. The earnings are there, the cash is there, the willingness to spend is there. Like it's a little bit of a high convexity trade still, we think.
Darrell, something is breaking higher, and I promised you we'd come back to it. So yes, you like the financials. I understand that steeper yield curves underpin some of that call. That break high we're seeing again in yields, quite stealthy, not seeing too many headlines on this at all, but retesting the highs of the year. On the 30 in America and abroad, we're looking at 10s in Germany, 10s in the UK. What do you think's happening here?
Well, look, it's no secret when you get out on the long side of the curve, what it is it's an interest rate with a term premium, an inflation premium, and a growth premium stacked on top of it. That's how you get to long-term interest rates, whether it's in the U.S. or internationally. Obviously, with $111 crude, those inflation premiums are going higher. We think they should. When I was on 30 days ago, I said, look, one of the things that's underappreciated, we think, in this market is the long side of the U.S. yield curve is still too low. If you look at the 10-year, it's been trading essentially at 4.3% back and forth for almost 3 years plus running now, since almost October of 22. It's just been stuck in a very tight range. We think those interest rates need to go higher, right, for the reasons I just talked about, stacking those premiums. The question becomes, and it is the existential question here, John, is where do those higher interest rates start to create indigestion for equity prices and equity markets, right? We think in the U.S., it's somewhere north of probably 460, 475 on the 10-year. We're not there yet, but we do think rates need to go higher, and it's exactly what's happening right now.
Darrell, thank you, sir. It's good to see you. Appreciate the catch-up, the update. Darrell Cronk there of Wells Fargo. 10-year notes this morning, yields up 2 basis points, 436.
Yeah, and you've got a $44 billion auction of 7-year notes later today at 1 p.m. And do we get the same kind of indigestion? Yesterday we saw short-term notes auctioned. Just want to say, it does feel like this is a different kind of sell-off in the bond market because it's for the right reasons. It's for the strength that's in the underlying economy, not necessarily totally in tandem with oil prices. Nonetheless, I feel like the theme of this week is boiling the frog, just slightly boiling the frog.
Which John Stoltzfus is very disappointed in.
He just thinks it's not very nice to the frog.
Yes, apparently. He was very emotional, sentimental this morning.
The chickens are going buck, 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 and the frog is getting upset.
If you missed that, don't worry. Yields are up across the curve this morning. 10-year yields very close to 440, 435 this morning. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. We are seeing UPS shares falling nearly 3% in the pre-market. The company posting first quarter earnings that exceeded expectations, but the Courier opted to leave its financial guidance unchanged. JetBlue shares, meanwhile, are slightly lower in the pre-market. The airline reporting first quarter earnings that missed analyst estimates. The company also announcing plans to slow hiring in the second half of the year to align with reduced capacity. And President Trump welcoming King Charles to the White House at the start of his first state visit to the U.S. since becoming king. The trip comes at a tense time for UK-U.S. relations, with Trump repeatedly criticizing Prime Minister Keir Starmer over his stance on the Iran war. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. More from Yahara in about 15 minutes' time. Up next on the programme, holding the red line with Iran.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear.
Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning. Here's the tale of the tape this morning. We're negative by 0.4% on the S&P 500. On the Nasdaq, here's your underperformance, down by 0.9. Story keeps going back to the Wall Street Journal. Fantastic reporting from them, by the way, suggesting that internally over at OpenAI, they're falling short of expectations. The CFO seems to be worried about the commitment to spend, and the people receiving, or will be receiving, should be receiving some of that spending, trading much lower in the pre-market this morning.
This is a name, OpenAI. It is a private company, but it has a huge footprint when it comes to the investments by public companies that have really thrown their faith behind this one company. Increasingly, when it released ChatGPT, it was novel. It was something that attracted everyone's attention of the promise of artificial intelligence. Now we've got Gemini. Now we've got Anthropic. Now we have every single company putting in their own iteration, and raises questions about OpenAI's place in the future.
It's the worst of both worlds this morning on the tech front, on the oil front as well. Brent crude out to 111, pushing 112, higher this morning by more than 3%, as Lisa has indicated. Some of the longer-dated contracts making new highs. Big focus on December as we approach year-end, or at least start to think about that. The tension builds, and you see it in crude prices this morning.
Tension building, no impasse. We're still at an impasse. There's been no breakthrough. And based off the reporting yesterday, the president is very skeptical and doesn't like this idea the Iranians are floating, which is we'll reopen the Strait of Hormuz, but we're not going to negotiate just yet on nuclear. That's unacceptable to the United States.
Crude this morning up more than 3%. Under surveillance this morning, holding the red line with Iran.
The proposal was being discussed. I don't want to get ahead of the president or his national security team. What I will reiterate is that the president's red lines with respect to Iran have been made very, very clear, not just to the American public, but also to them as well. So I wouldn't say they're considering it. I would just say that there was a discussion this morning that I don't want to get ahead of, and you'll hear directly from the president, I'm sure, on this topic very soon.
So here's the latest this morning. President Donald Trump telling advisors he's not satisfied with Iran's proposal to reopen the Strait of Hormuz. Bloomberg's Tyler Kendall has the latest from Washington. Good morning, Tyler.
Hey, John, good morning. Well, this White House still maintains that there needs to be curbs on Iran's nuclear capabilities for any sort of deal. In fact, the U.S. Energy Secretary Christopher Wright was pretty clear on this program last hour that it's not something that the administration is willing to compromise on. The thing is, it doesn't appear that it's something that Iran is willing to negotiate on, at least for now. Instead, the country is proposing that we could see a potential reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade and maybe making some other concessions, according to Iranian state media, including compensation for damages, assurances that Iran will not be attacked again, and then a legal structure for the Strait of Hormuz. But as you mentioned, it appears that the administration is wary of this proposal because, in large part, a lot of these points have been non-starters, at least publicly, for the U.S. You had Secretary of State Marco Rubio just yesterday saying that Iran cannot retain any control over the strait and that the U.S. isn't going to lift the blockade because, in large part, it's been such a big point of leverage. Annmarie's already mentioned that research out from Kepler that it appears that they are estimating that Iran only has about 12 to 22 days left of spare oil storage capacity. And John, at this point, new data analyzed by Bloomberg shows that it does appear that the first LNG shipment did make its way through the Strait of Hormuz, but our own analysts are cautioning while this may give some renewed sense of optimism, at this point, all LNG tankers appear to be staying put, at least for now.
Tyler Kendall with the latest in Washington. Tyler, thank you. Let's extend and build on this conversation. General Karen Gibson of Academy Securities writing for us, reopening the strait is a matter of urgency and Iran knows it. I suspect Iran is gambling it cannot last us here. General Gibson joins us now for more. General Gibson, that last line, is there good reason to believe that Iran can outlast the US?
Well, I think it's a matter of political fortitude on our part. And if we want to achieve the objectives of this campaign, which were, as we've just heard, to impose very strict limits on Iran's ability to gain nuclear weapons, then this key leverage is something that we need to sustain. I think it's telling the actions that Iran is taking right now and indicating, as you said, that, the combination of previous sanctions, of the wartime infrastructure damage, and now essentially a maritime blockade, our interdiction efforts are probably beginning to take a toll on a regime that has previously proved very resilient to economic pressure.
Well, if the Iranians are so resilient, do you see the United States doing anything before they reach their maximum capacity on storage in the oil industry called tank tops?
I think that the strategy that we have now, really this post-kinetic phase of using our military assets mutually, Iran is doing the same thing, to exert economic pressure on one another, Iran preventing essentially the flow of traffic in and out of the strait, and the U.S. Navy preventing the flow of traffic in and out of Iranian ports, is proving to be pretty successful. Again, I think when we look at Iran's negotiating strategy at this point, trying to decouple the economic pressure from the nuclear discussions. I think they're seeking economic relief. They want military relief in terms of sustaining the ceasefire. And then that would allow them to postpone, drag out, or negotiate at least on the nuclear aspects from a position of a less coercive position, in greater advantage to them.
If Trump cannot open up the Strait of Hormuz diplomatically, will he do so with the military?
I think in terms of opening it with the military, that would really mean escorting tankers and other vessels, as we've talked about before. It's certainly a feasible military option, and I don't think that Iran would be in a position to really strongly contest that. They could strike, take pot shots at vessels that are going through, but I think if they did that, they would be inviting more of those very punishing airstrikes that we've levied in the past.
General, what do you make of the comments we've heard from both the administration and other analysts that there really isn't any kind of cohesion in the Iranian leadership, that there isn't anyone like the former Ayatollah who could have come out and said, this is the route that we're going to take, the poison chalice that we're going to drink, and we're going to come to this agreement? Do you think that that's an accurate reflection of things on the ground?
Well, I certainly think it's fair to say that the current Ayatollah lacks the strength of his father to act, certainly with greater authority. But I think that the IRGC is really the Iranian Revolutionary Guard Corps, remains probably pretty cohesive. I've often heard there are no real moderates among those who are in charge. It's just various factions of hardliners. And I'm not sure we see yet concrete evidence that there's significant friction within the Islamic Republic's leadership.
General, what do you make of reports that there is some dissension from the rank and file that aren't getting paid because of a lack of cash coming into the regime?
So I think that's where we would probably be more likely to see some friction. Some of the indicators I would look for would be defections or units that are no longer willing to carry out orders. But now that we're not conducting kinetic operations and Iran is not responding in kind, that's a little harder to detect, but those are some of the indicators I would look for that would lead me to believe that there was a growing friction within the security establishment.
General, always appreciate getting some time with you. Thank you very much. General Karen Gibson there. Thank you, of Academy Securities, on the latest situation in the Middle East. Iran is very good at dragging things out, making negotiations go on for a long, long time, stringing people along throughout political cycles and looking way beyond the next 3-5 years, looking out decades. But the stakes this time around, given the pressure, and the pressure is different, the stakes are a lot higher.
It's potentially holding the global economy at hostage, and it might potentially tie the hands a little bit more on the U.S. side. At the same time, the stakes are higher in Iran as well, because ultimately they could have their purse strings completely tapped because their people are willing to close the Strait of Hormuz and any shipment of Iranian oil in a way that just hasn't happened before. This is where the pressure gets sort of into a question of who feels it more first to bring someone to the table.
If you see what the Iranians are doing in terms of going after empty vessels, trying to put some oil, which is very difficult, on a train to China, you can see that they are very desperate, and it's just a matter of weeks until they really are going to run out of that storage capacity.
Making new highs this morning in the oil market, making new lows in the equity market. We're down by 0.5%. You'll just notice Microsoft rolling over just a little bit. Nvidia making new lows for the session as well. That stock is down by some 2%. The pressure on tech this morning, the resilience elsewhere. We'll catch up with the GM CFO in just a moment. Tuesday was meant to be a snooze. Wednesday was the big day for financial markets this week. Still is, but some moves this morning worthy of exploration. Let's talk about it. We're down by 0.5% on the S&P. On the Nasdaq, we're down by 1 full percentage point. Attention very much on that report from the Wall Street Journal, indicating that over at OpenAI, there's some difficulties and they're falling short of their own targets. That's weighing on things like Oracle, weighing also on Nvidia. And this is where the conversation gets a little bit more compelling for me. Obviously, the read across is, OK, OpenAI have got all these spend commitments. What does it mean for the likes of Oracle? I'd ask the question, too, what it means for everyone else who's spending all this money trying to fight off the OpenAIs of this world. What does it mean for them as well?
Yeah, we've been talking about this over the past couple of months, that OpenAI was bidding up a lot of data center space, saying we want to just secure the data compute so that we can get out ahead. And that caused the likes of Meta to come out and actually secure space that they didn't even need in order to avoid having OpenAI get a hold of it. Is there sort of almost a bubble of existential risks that's been baked into some of this data center valuations that needs to come out as people right-size their expectations of what's actually needed in the face of demand that's coming through, at least according to this report, slightly less than people expected?
How existential is that existential risk? That's a story we can talk about tomorrow. We have had a fantastic run for the chip sector. over the last month, so taking some heat, just a little bit of heat out of a massive rally. Let's turn to the other reason things are breaking down a bit in the equity market. Yields are breaking out. So the high of this year on a closing basis on a 30-year bond, the long bond, 496. This morning, 496. So retesting the highs for certain parts of maturities in the yield curve. Same story over in the UK, in Germany as well, doing the same thing with this taking place in crude. Brent, WTI, making new highs for this morning. Brent close to 112. WTI back in triple digits this morning and higher by close to 5%.
It's just been creeping higher and higher and higher as we get further and further away from some sort of agreement. Yes, you can get a headline. Maybe Axios will be out with something in a bit. But
Poor
either way,
Axios, eh?
okay, I mean, yes, although it's turning into a meme online. I mean, let's just be honest. It sort of has been pretty well timed. That said, I mean, great. There are talks about talks, but the market's saying, okay, we aren't going to necessarily take that bait every single time because it hasn't come to fruition.
Talks about talks have been doing a lot of heavy lifting.
Correct.
That's for sure. As we count you down to the opening bell, lots of stock stories to talk about. 2 hours away from the cash open with some morning movers. Yahara has more. Hey, Yahara.
Exactly, John. Lots of earnings to get through. And we start with GM. A standout. Shares are up 4.4% after it posted a beat and a raise. The driver is strong demand for its pickup trucks and SUVs, even as gas prices climb, that helping to offset some weakness in its EV vehicles. But the big question is, how long can that resilience in its gas-guzzling vehicles last if gas prices continue to climb? Moving on to the consumer with Coca-Cola, shares are up 3.25% after it beat sales expectations. That's because the company has been able to push through higher prices and shoppers are still buying their products. But in a sign of some stress or maybe the GLP-1 effect, Coke saying that some of its growth is due to shoppers buying smaller sized bottles. And we end on UPS, down some 3.75% in the pre-market because even though it beat on earnings, it held its outlook steady. Compare that with FedEx, which boosted its outlook, and you get some disappointed investors. John?
Yahara, thank you. More from Yahara in just a moment. Let's talk about some earnings. General Motors reporting better than expected first quarter earnings and raising its full year guidance. The General Motors CFO, Paul Jacobson, joins us now for more. Paul, welcome to the program. The buzzword this earnings season appears to be resilient. I think it would be unfair just to call this resilient. It looks strong, sir. Paul, where is that strength coming from?
Well, good morning, John. Thanks for having us. This quarter was a really strong one for us, but I think that resiliency word works really well. It's something that we've demonstrated for the last several years, whether it was the chip crisis or tariffs or inflation. I think the teams responded really well, and this quarter was no exception. When you look at some of the challenges that we faced around inventory levels, the go-to-market team did an outstanding job dealing with the traffic that we saw in the stores, which continued to be strong and steady and has continued through April. So we feel good about the quarter, and we're able to take up our guidance as a result of the IEEPA tariff accrual that we took in the quarter. And so far it looks like we're able to handle some of the pressure that we've seen in inflationary items, primarily resulting from energy prices.
Well, Paul, let's talk about that. It's an important topic. Your supply chains have been battle-tested, battle-hardened. The pandemic, the tariffs, and now this. What challenges are you working through as a team at the moment?
Well, I think right now, obviously, the team's done a really strong job of maintaining it through even some of the DRAM memory chip issues that we saw in the middle part of last year. I think a lot of that has calmed down, but what we're really seeing across the board right now is inflationary effects in raw materials, aluminum, steel, just overall transportation and logistics costs. We're calling out about $500 million of pressure that we've added to our forecast for the year. So despite our beat, we're not taking up our guidance by nearly as much as that beat, primarily because we're continuing to adjust the business. But we feel good that we're a little bit ahead of it right now, but we are cautious about how long this might last.
How much are you able to pass along those extra costs, Paul, to consumers in the face of already relatively high prices, but a very strong consumer demand?
Yeah, so we came into the year saying that price was only going to be up by about 0.5%, which really was the annualization of model year 26 price increases. We haven't built any significant price increases into our models. In fact, what we're seeing is the industry discounting a little bit more. There's some competitive pressure out there, but our team has held up well. I think when you look at the GM portfolio, we've really got a vehicle for every consumer out there. We're known for our trucks and our SUVs, but we sold over 700,000 vehicles last year with a starting price of approximately $30,000 or less. So we've got that portfolio. The Chevy Trax is hitting record levels for us last quarter. So we feel like we're in a good spot depending on where the consumer might be.
Has there been any pushback against some of the large vehicles, the SUVs, the pickups, in the face of higher gasoline prices, or have you seen no ramifications whatsoever?
We really haven't seen any changes. In fact, our light-duty pickup sales were up about 8% year over year in the quarter. And like I said, traffic has been strong. If anything, we probably were a little bit light on inventory coming into the quarter because we had such a strong December, and with the weather in January and so on, we had difficulty making up those inventory levels. So we're down quite a bit from where we were a year ago. It gives us an opportunity to replenish that stock and make sure that we've got product in the stores at our dealers for customers when they come. But so far, traffic has remained steady.
Paul, when it comes to the tariffs, how is it going in terms of getting the refunds back from the U.S. government? We're exposed a lot differently. I think many companies out there are principally focused on IEEPA. Many of our tariffs are under Section 232. And there's been a pretty robust process. We haven't had any challenges with the offsets and making sure that we're getting the accounting right with the government to make sure that the cash is flowing efficiently. With IEEPA, with the Supreme Court decision that was somewhat unexpected, we took the accrual. We have not moved our free cash flow guidance like we did our EBIT because we're not sure when that refund is going to come. We haven't applied for anything yet, but we're going to work through that with the government in partnership because I think that partnership has worked really well as we've adjusted and tried to benefit the U.S. auto industry the best we can. Well, how deep is this partnership? A few weeks ago, there was a report that the Pentagon is talking to General Motors and other auto companies about making munitions and helping in the war effort. Is that accurate, and where are those conversations now?
Well, I can't comment on anything specific, but we do have a growing GM defense business, particularly with the infantry squad vehicle, which has been great for the troops and for the department as well. But this is taking advantage of really strong U.S. manufacturing, and that's where we lead the way, I think, as automakers and do a great job. So, while we would rather not be paying tariffs across the board, we understand the environment that we're in, and we're making sure that we can pivot the business the best we can to adjust to that reality. And I think the team's done a good job when you look at the consistency of our earnings over the last several years.
The earnings speak for themselves, Paul, at a difficult time. And we talked all throughout this interview about the challenges on the horizon. How does that inform your approach to capital returns for the year ahead?
Well, our capital allocation policy starts with investing in the business. We'll put $10 to $12 billion in. Much of that this year is actually onshoring work that was previously done internationally. We're bringing that in as a result of our tariff response. The second pillar of our capital allocation is making sure we've got a strong balance sheet. And when you look at where our balance sheet is, how funded our pension plans are, we're in a really, really strong position. And what that's allowed us to do is take some of that free cash flow and allocate it back to shareholders to reward them for their confidence in the GM story and make sure that they're generating the returns for their customers as well. During the quarter, we were able to repurchase about $800 million worth of stock at about $75 a share, taking advantage of some of that dip and continuing to be very, very consistent about the way we apply our capital allocation.
Paul, when you look forward and at the potential priorities of General Motors, how much do you see EVs as playing a bigger part just because of some of the questions around oil, as well as, of course, autonomous driving?
So while we did take a number of charges, special item charges last year and even in the quarter as we continue to right-size our EV footprint as a result of the new regulatory environment, unlike many of our competitors, we're sticking with our models. You know, we discontinued the Wright drop van for very specific reasons, but we're not impairing any of our other EV programs like some of our competitors. We continue to believe that we can make EVs work through our winning platform. They're not affordable, or not profitable at these levels right now, and that's something that we've got to work on. So we've got a number of battery chemistry architecture initiatives coming in over the next couple of years that are going to get the costs down, and where we think we can take and continue our leading role. We're already number 2 in the U.S. In EVs, and think we can continue that and to continue to grow it in the future.
Paul, before we go, inquiring minds want to know, the Corvette behind you, what kind of money do we need to come up with?
It's definitely in your price range, John.
We'll have a whip around the table. Thank you, Paul.
Whip around.
Thank you. I'm just pleased that Paul believes that I can afford it, so that's something.
What wasn't that the whip around at Blackstone? Wasn't that the one where they went around?
I don't think our whip around this table is quite the same as Blackstone's whip around.
What did they come up with? $15 million.
$100 million.
$100 million
Something
for
like
you.
That. Yeah.
You know, it's the Corvette.
It's a beautiful car. Paul, thank you. Appreciate it, sir. Thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. The DOJ charging a California man with trying to kill President Trump over the weekend. The 31-year-old making his first appearance in federal court, where he was also charged with gun offenses. The suspect sent a manifesto to family members that was included in charging documents. Investors in a Blue Owl fund tendered less than 1% of shares to Saba Capital Management and Cox Capital Partners, which had offered to buy them out at a steep discount, but they said no thanks. Sources telling us here at Bloomberg the offer expired at the end of last week and was not extended. And 9 jurors have now been seated in the case of Elon Musk versus Sam Altman. The lawsuit claims Altman broke with the original mission of OpenAI, shifting from a nonprofit vision to a profit-driven model without Musk's knowledge as a co-founder of the company. That's your Bloomberg brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next on the program, the Fed on the sidelines.
Clearly, the shift has been to a wait-and-see mode. I think it'll be a pretty high bar for Warsh when he comes in to build consensus around the idea of rate cuts anytime soon.
We'll catch up with Seth Carpenter of Morgan Stanley in just a moment. From New York City this morning, good morning. This is Bloomberg Surveillance. Equity futures session lows, bond yields session highs, likewise in the oil market as well. Equity futures breaking down by 0.6. Big tech story this morning, down 1% on the Nasdaq. In the bond market, check it out, 2s, 10s, 30s, the long bond, the 30-year. Yields up just a single basis point, approaching 496, which is the closing high of the year, and 2s up 4 basis points, getting interesting at 384.
This isn't necessarily coming from histrionic discussion of mass rate hikes at all of the central banks. Nonetheless, it is coming with better than expected growth and higher longer-term expectations for oil prices. I'm sorry to repeat myself, but boiling the frog. You're seeing this in oil prices and you're seeing this in the bond yield space. That's giving a pretty interesting signal right now.
Heading into the Fed's 2-day meeting under surveillance this morning, the Fed on the sidelines.
Clearly, the shift has been to a wait-and-see mode as opposed to a we need to cut. There's plenty of officials who are worried about, the stickiness of inflation, the impact of higher oil prices. So I think it'll be a pretty high bar for Warsh when he comes in to build consensus around the idea of rate cuts anytime soon. Powell's comments are going to be less focused on his view and more about what the committee's saying.
So here's the latest this morning. Traders expecting the Federal Reserve to hold rates steady tomorrow in what's likely to be Jay Powell's last policy meeting as Fed chair. Seth Carpenter of Morgan Stanley joins us now for more. Seth, good morning.
Hey, Jonathan, how are you?
Good to see you, sir. Are you expecting more explicit two-way guidance at tomorrow's meeting?
I am expecting a lot of caution on Jay Powell's part, not at all because of the political environment, but because if you're writing down forecasts At this point, you have to write down a whole set of scenarios. And then if you ask yourself, which scenario are we going to be in? As Lisa said, there's sort of pressure for maybe higher oil prices forever. Most history says oil prices go up and then they come back down. Then the news cycle happens and you change your view. We're in scenario 1, we're in scenario 2, we're in scenario 3. I think Powell has no choice but to accept that fact. I don't know how you can do monetary policy. I don't know how you can do economic forecasting other than to say we have to see how things go when it comes to oil prices.
The priority at the last news conference was to anchor inflation expectations, at least do that verbally. With that in mind, do you think there is good reason to come out and say, even if they don't believe it, there is just as much chance as a hike as there is a cut for the year ahead?
So I'm not convinced that they need to go that far, although it's clearly possible. I think right now where we've been, the Fed feel very strongly that the excess inflation that we have right now, so core inflation, call it just over 3%, that the bulk of that in the Fed's view, if not all of it, the excess, is coming from tariffs, and that should be fading over time. I share that view, if perhaps not quite their conviction. And then I think they will also want to say that history tells us that the pass-through from oil prices, energy prices into U.S. inflation, clear at the headline level, much more muted at the core level. And so I think, in some sense, he might want to lean into that history as a way of trying to remind people of why inflation expectations might stay anchored.
That's all predicated on the idea that there actually is demand destruction, and that actually some consumers stop spending or are unable to spend as much and actually growth slows. One of the interesting aspects of the past couple of weeks is that we've seen earnings beating expectations, consumer indicators actually showing an acceleration, not necessarily a retrenchment. At what point can they honestly say that they've seen a real cooling in the labor market, given the fact that it's unclear exactly what that dynamic is?
No, I think you have highlighted exactly the path to a rate hike, which is inflation stays higher than they expect. The cooling, the deceleration that they've been looking for just on prices doesn't happen. And then the real side of the economy not only doesn't start to buckle, but maybe gains a little momentum. Now, we've been of the view that the momentum of the economy is there. It will probably sustain itself, broaden in the second half of the year. If that happens, and not only does inflation not fall, but maybe starts to rise, we're going to see a very, very different tone from the Fed.
Does it matter what the Fed says right now? Because it doesn't matter if Fed Chair Jay Powell isn't going to be the Fed chair in the next meeting. And it will be very interesting if he stays on as governor. That's all that anyone is ever going to ask about at this particular meeting.
I think it does matter for a few reasons. One, there's a very high chance that Chair Powell stays on as a governor. And I think in that sense, he'll be a permanent he'll be a permanent voter. I think second, one of the things that the chair tends to do at the press conferences is try to reflect the view of the committee, reflect the range of views on the committee. And if everything goes according to the plan and Kevin Warsh is confirmed and becomes chair in short order, the committee as a whole isn't going to turn over that much. There's going to be that change, the chair, and the chair clearly matters, but it's not as though the committee is going to be completely different. And so whatever Powell is able to reflect about the thinking of the committee, I think we need to take that seriously because it will inform where policy goes, at least for the rest of this year and into next year.
Do you think there's more of a chance he stays on than doesn't?
You know, in some sense, that's like the oil price. Each day there's a new headline, and I have to revise my expectation. You know, he said that he wants to stay on until the investigation is well and truly over. I think he has to define for us exactly what that means. I'm not sure I have great insight as to what exactly that means. I feel reasonably confident that your peers in journalism there at the press conference will ask him that once and then again and then again.
Let's hope it's the first question, not like the sixth or seventh, like the last Fed press conference. But in terms of the politics surrounding this, if he were to stay on, does that create confusion?
The list of confusion for me, at least, in forecasting the economy right now is very long. I would put that further down the list. I mean, like I said, I think for me, when it comes to what monetary policy is likely to do, especially, say, for the balance of 2026, really comes down to where the core of the committee is. The committee is a committee. Votes are taken. People make a big deal when there are dissents because policy decisions literally are votes. And because we're going to get a new chair, that can help adjust the tone, maybe what the debate is at the table, but I don't think it ultimately makes a big difference for this year for where policy ends up.
Do you think the way that policy is communicated might change And is that important to you as an economist who follows these institutions?
Yeah, no, I think almost certainly communication is going to change over time. But we've seen that essentially with every chair. I was at the Fed when Ben Bernanke introduced the press conferences, when he introduced the summary of economic projections and the dot plot. The press conference itself evolved over time. The statement itself evolved over time, and now there's a structure to it where the first paragraph has this important, looks backward. The second paragraph does something different. So an evolution of communication, I don't think is to be feared. I think it should be expected. But it's also very context specific. One of the things that Kevin Warsh has said is that forward guidance maybe has not served the Fed well consistently. And if you look at the economic academic literature, there's a lot of similar views that at the zero lower bound, for example, maybe forward guidance is particularly effective because you can anchor expectations. But when you're away from the zero lower bound, I think there's a consensus among macroeconomists that forward guidance is probably less important. And so, again, that evolution, person to person, chair to chair, committee to committee, but it's also very context specific.
Yesterday, we had an economist on who was saying that he expects Jay Powell to stay on as governor as Kevin Warsh reshapes the Fed in some capacities, that he would want to vote in exactly how things get restructured. Do you see that as a likely case?
Well, I mean, so we can go by some of what the chair has said, that he wants to stay on until he sort of feels like the legal questions are fully settled. I would say, having worked at the Fed when Jay Powell was there, he tends to make decisions very much based on what he thinks is right for the institution, for the country, for the economy, for the Fed's mandate. So I think that's going to be the primary motivating factor for him.
Seth, it's good to see you. Thanks for breaking it down.
Thanks.
Appreciate it, sir. As always, Seth Carpenter there of Morgan Stanley. The Fed's two-day meeting begins later on this morning, concludes tomorrow afternoon.
Yeah, and that will be the first question, I'm sure. Will you stay on as a governor? I am curious, though, about the economic questions, too. How do you set the bar and anchor inflation expectations, given the fact that there is momentum in the underlying economy, and higher oil prices aren't going to necessarily go away so quickly?
I'm slightly worried, somewhat concerned, that this question over Powell's future introduces a dependency issue when it's not clear there is one. That we start to believe that in order to defend central bank independence, Federal Reserve independence, we need Chairman Powell to stay on this Federal Reserve board for the next 2 years. That brings its own problems if you start to think that way.
Well, it ends up in the 1948 to the early 1950s of the Eccles Federal Reserve. And are we in a parallel moment of restructuring? And I think a lot of people are wondering that.
Inflation expectations would say no, but maybe inflation expectations are wrong. I'm reading this story completely the wrong way. We'll have that debate tomorrow. Up next on the programme, a man who upgraded his price tag on the S&P 500 at the very start of this war. That's next.
We're kind of seeing everything rally.
Obviously, there's going to be some pullback.
Earnings are strong, but a lot of that strength is being driven primarily by tech.
We have to look through to the actual earnings and fundamentals.
We still see higher equity markets by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. The price action, the scores looks like this. Pulling off all-time highs on the S&P 500 in back-to-back sessions. We're pulling away from them this morning. We're down by 0.7% on the S&P, underperforming on the NASDAQ. The NASDAQ 100 down by 1.3%. The why? The Wall Street Journal indicating OpenAI are falling short of their own targets. That's taking down Oracle by more than 6%. And it's not just a tech story. Commodities out to new highs this morning. 7 consecutive days of gains for Brent, up by 4%, 112. WTI, triple digits. And with that move, this move in bonds, yields, 2s, 10s and 30s, 2s up 5 basis points, 3.85.
Heading into that two-day meeting of the Federal Reserve after we got a Bank of Japan decision that was split because there were a significant number of members, 3 of them, that did want the board to hike rates from 0.75%. How does the Fed take a look at a stagflationary shock, given the fact that we've seen earnings remain intact? At the same time, do we start to see some pushback with the OpenAI type of report leading to maybe similar types of nodes in the other tech earnings? I mean, how much does that really set the bar that much higher for what we hear tomorrow?
WTI north of $100 a barrel. is massive for this White House. They've been wanting to keep it below $100 a barrel. And right now we have Chris Wright talking to us early in the program saying that Iran doesn't have a huge amount of storage left. They're at this impasse. It doesn't seem like the president is willing to take the Iranian proposal, will open the strait, but kick the can down the road when it comes to nuclear. And the administration says they're absolutely not, even though I've heard otherwise, they're absolutely not studying this idea of a ban on export of oil products. So basically what we could potentially see going into peak driving season is a lot higher gasoline prices.
420 around those levels right now, 420 a gallon on average in this country in the last 24 hours. That's a new high since this war started. This cross-asset mix gets my attention this morning. Longer dated crude prices out to new highs. Bond yields, not just in the US, but in Europe as well, retesting the highs of the year. At the same time, the equities are 13% off the lows on the S&P 500, supported by earnings. And the earnings, the good news, because we've talked about the bad news so far, the good news is the earnings so far this morning have been pretty decent.
Yeah, GM coming out, beating expectations. Coca-Cola upgrading their full-year forecast. We've seen even LendingTree coming out and actually outperforming, as well as all of the major credit cards. Airlines outperformed, even though we are hearing on the margins that people might be cutting back a little bit in the past couple of weeks. You put all this together, it is a toxic brew for the Federal Reserve because there's enough strength to maintain the price increases that might pressure their ability to really respond to any weakness in demand destruction with any kind of rate cuts.
That Fed decision tomorrow afternoon. Futures negative 0.7% on the S&P. Coming up this hour, Venu Krishna of Barclays with the market rally stalling. Lindsay Piegza of Stifel saying a Kevin Walsh confirmation could lead to Powell stepping down. And Ben Reitzes of Melius Research with concerns growing over the future of OpenAI. We begin this hour with stocks pulling back from all-time highs. Venu Krishna of Barclays writing real money demand could normalise considering how far inflows are running, but portfolios have room to continue re-risking. Venu joins us now for more. Venu, good morning.
Good morning.
Credit to you, sir. Let's give you a victory lap. Just briefly, I think it was March 24th you came out and raised your target for the S&P 500, which felt absolutely bonkers at the time. Since that day, what have we moved? 10%? Almost 10% off those levels?
I think last I checked, 13%.
13 off the lows. 13 off the lows. Your call was about a week before the lows. Don't get too excited here, Venu.
Last I checked, like he doesn't wake up every day and check.
Okay, Venu. Let's talk about the reset. Massive rally from where we were. Earnings seem to be supporting that so far. What's the outlook look like now?
I think the outlook still is optimistic, but obviously given the pace of the move and the speed, and we noted that this was one of the fastest moves in the last 35 years from a trough. So I think the speed itself gives you a little bit of reason to take a step back and take a deep breath. But once again, I think like the driver behind our optimistic outlook a few weeks ago, the core earnings strength is very, very strong. If you look at some of the big investment growth drivers, they've actually expanded. So earlier we were hanging our hat on AI capex spend. Now with the war, interestingly, across the developed markets, you are potentially looking at a defense spending cycle and an energy security cycle, right? You put all that together, there's a lot of sort of capital which will come into existence. And I think the other important thing, the AI narrative, the stocks did stumble from late last year into early Q1, but that is very much intact. In other words, the capital spending is higher, their earnings are strong, adoption is increasing, and the expectation is that the spending on AI will broaden to include sovereigns and enterprise, so expanding. So I think this mix at a time also when you look at the macro point, consumer sentiment has been weak broadly for the last 2 years.
Yep.
But that is not reflected in hard data of what they're spending. So the resilience of the US consumer is an important factor behind this, and that hasn't broken as yet. So, and the last point I think to note is that typically, if you look at the earnings revision cycles, they start high and they get cut. And they reach a low point by the end of March. And then things actually are better at the end of the year versus where we are in March. This is one of the rare years in which we've gone the other way. Numbers are going up. Now, in all fairness, that's largely being driven by tech and other adjacent industries which are benefiting from the capital spend. But, one way or the other, the point is that the market remains dependent on tech, which by our estimate, depending on how you define it, is approaching 50% of the market, and there the strength is intact.
So let's talk about tech and let's talk about CapEx. You alluded to this. Are the sources of the CapEx broad enough for us to sit here this morning, appreciate the importance of that OpenAI story, but look past it?
No, OpenAI is very important, right? If you look at what is going to happen, one of the questions we get from clients a lot is, how are investors, for example, going to readjust their portfolios given that massive pipeline of IPOs coming to the market? OpenAI is a big part of it. What OpenAI and Anthropic and all they reveal in terms of their financials, in terms of the growth, in terms of the customer base and models and everything else, is going to be critical to the whole AI infrastructure. And of course, with the case of OpenAI, they have the tentacles deeply embedded across the whole AI ecosystem. So I think it is definitely worth watching, and it definitely will. That's why you're seeing a little bit of a dampener this morning. But my instinct is to look past this. One data point is not going to change the story. The narrative has broadened, in fact, in the last 6 months. And there is, in fact, it is now a consensus view that this AI narrative is indeed transformational.
Which is the reason why I think some people are getting a little skeptical and wondering if valuations have gotten a little bit high. A lot of it's also predicated on the idea that technology can be completely independent of a lot of the events that are transpiring, whether it's with respect to oil prices, whether it's with respect to interest rates. It just is this existential risk that people just keep needing to spend it on. At what point do you think that'll get tested, given the fact that we are seeing oil prices creep higher and we are seeing a question around just how far this can go?
I think right now, as you point out, effectively there is a disconnect between the macro concerns right now and what is happening in the risk assets, whether it's credit spreads in the high yield, IG, or equities, risk premium, or to that extent equity earnings. They're all robust. I think disconnect will happen when you start seeing the impact of that flow through in the growth expectations and dynamic, and perhaps on the inflation expectations as well. That hasn't happened to a meaningful extent right now. And that's the reason why, even though the rates market has moved higher and there is some uncertainty, but it has been reasonably well anchored. I would say 10s below 4.5. Like I've said in the past, I think the 10-year especially moving higher, beyond 4.5, going towards 5s, which we tested, by the way, in the last 12 to 18 months, is something which means that the macro risks are indeed spilling over, and equity markets will have to react and recognize that risk. But right now, we are in a relatively sort of safe spot where the earnings story is overpowering and strong enough with growth rate accelerating. Last year, we posted over 14% growth, higher than what we expected. This year, we are saying 15, 16%. Consensus is already closer to 18, 19%.
But it's all consolidated in the biggest companies, and you're seeing a lot of the gains really increasingly concentrated there. JetBlue reported earnings. We were just hearing about that from Yahira, and they missed completely. They have a wider than expected loss. They're probably going to be laying people off. They've talked about how we don't have to declare bankruptcy. Yeah, you never want to hear those words. I just wonder, from your perspective, how much of a warning shot is this versus just a market where the weakest players are going to fall out, and you want to just stay focused in the largest ones?
Largest one for sure. We have been saying that for a while. We've liked big tech from Q4 of 22, and we haven't changed our opinion. But also note that what you're telling me is exactly what has been happening in the market for the last 18 months, which is correlations are extremely low. Returns dispersions are very high. We have moved away from a storyline of rising tide lifts all boats in the AI perspective to a winners and losers sort of a story. And that is extending across every sector in terms of who's managing the costs well, who can pass through, who have better pricing power, who's less disrupted by AI, whose model is more defensible, right? So that story is rolling, and I think we are in that phase. Idiosyncratic risk is extremely high. That's why, if you look at the options market, the earnings this week is a bigger catalyst than the FOMC decision.
We agree with you.
That just tells you that a third of the market cap, roughly approaching, is reporting, and the market is spruced up and ready to take cues, right? And if something goes wrong, going back to the answer, that's where the cues will start coming. So it's worth watching. Let's see what you heard from OpenAI, right, which is still private. Let's see what the five guys say when they report this week down the...
What happens if that company doesn't make it? What would happen?
OpenAI?
Yeah.
That's a tough question. And we've sort of bizarrely gotten this query, I think, in the past as well.
You get a lot from clients, don't you?
Yeah. Every now and then we get that. I just think that ecosystem is too big. They're too central. And I think they've shown to be very flexible, right? Look, for example, look at Meta, how they did a 180 on their business model. Look at a company like Microsoft under Satya. They changed, they moved the 800 pound tanker, massive tanker in the whole business model. I think OpenAI is too central. They'll adapt, but they're large enough players where this is a capitalistic setup. I think the market will absorb all these sort of moves.
Too big, too central, too big to fail.
I'm not too sure. Because the ecosystem has significantly bigger players. Look at Anthropic. Look at how they are racing ahead in terms of their revenue print. Look at companies like, for example, Cursor, which is a private company. Look at the revenue run rate. I think we are at a very pivotal moment right now in which significant amount of changes are unfolding right now. I think it's important. It's an important risk factor given how deeply they are embedded. But I'm not too sure that it's worth, frankly, even speculating that something goes wrong. I think they will figure it out. The system in aggregate will absolutely figure it out. There'll be others who will step in, and it'll dissipate quite seamlessly across the system.
Venu, right now, capacity constrained seems to be the view of things in this particular sector, and other people will be looking to step in.
Yeah, if they can't afford their data centers, well, probably Microsoft and Google and some of the others will. So that's the expectation that's maybe upholding.
That's the bull case, the rosy view of things.
The less rosy view is that maybe all of that capacity wasn't needed because it was being built out in the hopes and dreams that didn't really come to fruition.
Venu, it's good to see you. Thank you, sir.
Thank you.
Top call, by the way. Fantastic. Thank you. Venu Krishna there of Barclays. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. As you were discussing, pressure mounting for OpenAI, the Wall Street Journal reporting the company failed to meet its own goals for sales and weekly active users for ChatGPT. The shortfall is fueling internal fears that OpenAI may struggle to fund its massive AI infrastructure spending. Saudi Aramco is suspending liquefied gas shipments due to damage at its main export facility from the Iran war. Sources telling us here at Bloomberg that Aramco has informed buyers that shipments will be suspended through May. The news coming as Brent crude prices are pushing past 3-week highs. And we are seeing Coca-Cola shares rising 3% in the pre-market after first quarter sales topped expectations. The company has been raising prices on its drinks and consumers are still buying. Plus, some of that growth is coming from shoppers opting for smaller sized bottles. That's your Bloomberg brief. John.
Yahira, thank you. Thank you very much. More from Yahira later this hour. Up next, the Morning Calls. Plus, we'll catch up with Tom Fitzgerald of TD Cowen, breaking down the latest results from a struggling JetBlue. From New York City this morning. Good morning.
The president's focused on getting the right deal. That could be independent of their storage, but obviously that puts great heat on Iran. If we can get the right resolution, that could be tomorrow, that could be 2 weeks from now. But what the key thing is the right resolution.
It was good to catch up with the U.S. Energy Secretary, Chris Wright, a little bit earlier on this morning. Taking off the table the potential of an export ban. Some speculation at the moment, that speculation making a comeback with gasoline prices in this country approaching $4.20, new high since the war started, and crude building on gains more recently as well. Check out equity markets. We'll start there. Pulling back from all-time highs. We're negative 0.7% on the S&P. On the Nasdaq, we're down by 1.2%. If you switch up the board and get to the commodity market, you'll see crude out to new highs this morning. Session highs 112 on Brent, a 7th consecutive day of gains, up by 3.5%. And WTI back into triple digits, 100.50 this morning. With that move in crude, this move in bonds, yields up at the front end of the curve, 2's up by 5. 2's at 384, still some 16 basis points away from 4%, which was a level that we were starting to talk about maybe we settle at with the prospect of a Federal Reserve thinking about hiking interest rates. That was the conversation of, let's say, 6 weeks ago. Things settled down since then. So I wonder what things look like going into the Federal Reserve meeting tomorrow afternoon.
Yeah, and what it means when the entire world is facing the same dynamic. The entire developed world is seeing their bond yields creep higher in face of higher oil prices, but also the likelihood that they're going to have to incur more debt in order to finance some of the programs to offset these higher energy costs. The Federal Reserve is going to be somewhat hamstrung by discussions about the political future, but also questions about how high the bar is for them to hike rates, not just cut. Will they put that back on the table?
The move in the commodity market has been a headwind for this market, a cyclical headwind for this market for the last 2 months. The support was coming from tech, not this morning. Oracle is now down by 7% in the pre-market. Keep going back to this journal story. That's what's driving things this morning, that OpenAI is falling short of its own targets.
Yeah, you can see CoreWeave, for example, which is also highly dependent on OpenAI, also absolutely plunging. Is this signal for what we're going to get tomorrow and Thursday after the bell with respect to some of the tech names that could signify that maybe demand is coming in just a bit softer? Or is this an OpenAI issue where they lost subscribers to Gemini, when they lost business to Anthropic, and simply they're trying to catch up and figure out how to keep some of the subscribers in tow? Is this just weakness, or is this really a tell?
Tomorrow afternoon could be wild.
It will be wild.
Amazon, Microsoft, Meta, Alphabet all reporting after the closing bout tomorrow. Let's get you some morning calls. That's the price action, the debate of the morning. First up, Citi lowering its price target on Palantir to 210, noting the multiple compression in software. Your second call from D.A. Davidson initiating coverage of Micron with a street high price target of 1,000, seeing strong AI tailwinds for the chip maker. And finally, Mizuho raising its price target on Amazon ahead of earnings, citing positive quarterly growth from its chip and AI revenue. That name down this morning. Like a lot of tech names, we're down by 1.5%. Let's turn to the airlines. JetBlue shares sliding after reporting a wider than expected loss for the first quarter. Tom Fitzgerald of TD Cowen maintaining a hold rating on the company while remaining bullish on the overall industry. Tom joins us now for more. Tom, welcome to the program. We'll spend some time talking about the industry, talking about the earnings in just a moment. I have one question with regards to JetBlue. Is there something in this company that the likes of United might want to buy?
Well, I think, there's been a lot of discussion about United's interest in getting back into JFK, so I think that would be viewed as the crown jewel. But they also have a great Caribbean franchise, major presence in Boston, and a huge fleet of Airbus. So I think there's a lot of assets that JetBlue has.
Right now, though, Tom, is JetBlue just indicative of how much pain there is in some of the more domestic and vacation-focused airlines, given the fact that ultimately all of them seem to be either having their hands out or reporting earnings that are somewhat negative?
Yeah, I think JetBlue was, they started from a deeper hole maybe the last couple of years, just given some of the challenges that had beset that company, many of them out of their control, like the GTF engine groundings. So I think if you're just starting from a position of fragility, any of these type of crises that seemingly hit the industry every year, it's that much harder to absorb them versus the Deltas or the Uniteds of the world, who are starting from we're a little more buffered by their profit base.
Do you think it is appropriate for some of the budget airlines to get a government bailout to survive? Do you think the consolidation is the best route? What's your take on that?
It's something that investors are grappling with. I think that prior to the last couple months, one of the bull cases on the broader industry was that you were seeing this process of unprofitable capacity leaving the system, and that would be supportive of a multiple re-rating, that there'd just be more rational players like other quality industrial subsectors. I think now this wild card that maybe there's just a set amount of capacity that won't be allowed to leave the system because it's deemed too important for price-sensitive consumers. That's a new risk investors have to grapple with, and maybe that whether it crimps the multiple re-rating story for the broader group, or possibly it causes more dispersion between the haves and the have-nots. That's something we're watching very closely. I think frustrating for JetBlue, given their presence in Lauderdale, given the opportunities that they would have there, they were viewed as a major beneficiary of ultra-low-cost rationalization. So I think every day it seems like the direction's changing, but yeah, it's definitely top of mind for investors right now.
Tom, you still like the industry. When you say you like the industry, is that just one or two names? What does that mean?
No, I think broadly it's still been an overall, the industry continues to gentrify, as United CFO likes to say. I think it's a lot healthier than it was 10 years ago, 15 years ago, 25 years ago. They have these crown jewel credit card programs. The earnings and revenue volatility is dampening. There's a nice deleveraging story going on a lot of names. It has consolidated into a healthier group of companies that work on diversifying revenue, that are getting better at charging more for their product and not underpricing and earning their cost of capital. I think Delta and United are out ahead of the group, and they have been for years. But I do think the industry continues to offer a lot of upside for investors over the longer term.
Tom, appreciate your time. Not great results from JetBlue this morning. Tom Fitzgerald there of TD Cowen. As we've been conducting that conversation, an interesting developing story in the oil market. This from the UAE deciding to exit OPEC and OPEC Plus starting on May 1.
This is a really big deal. For years, they've flirted with this, especially when they've come under, maybe I would say, pressure from the kingdom. And the UAE would say, we want to chart our own course. We want to produce more oil. We want to export more. Now they've finally made this decision, and it's coming officially that they decide to exit OPEC, OPEC Plus. They've been a member since 1967. They're the third biggest producer. This is a really big deal, and I think it shows that the Gulf is fractured at the moment on a number of issues, including energy policy.
Well, and some more headlines just crossing that the UAE is going to boost oil production gradually. So this would be the goal of exiting OPEC Plus, having their own control over how much oil they produce, and that OPEC's exit will help the country meet changing demand. You did see an initial move lower in oil prices. I do wonder, though, just to pick up the point that Annmarie made there about how much this signals a fracturing of the Middle East and what this says for the United Arab Emirates relationship with Saudi Arabia, which really has held sort of clout over OPEC Plus. Does this indicate something deeper, or is this just a practical decision in order to meet demand at a time of a lot of uncertainty?
As Annmarie alluded to it, it's been somewhat of a long-standing issue. What's interesting about this is you want to handle your own affairs coming out of this crisis. But that's a big move that indicates that this could be the new normal looking beyond this particular crisis.
Yep. And also, I think it just shows that the Gulf is not a monolith. These countries want to chart their own paths, but this is a massive move for Abu Dhabi.
Crude this morning, 112 on Brent, triple digits on crude. Big market moves, equity futures near session lows. Equities near session lows were negative 0.75% on the S&P 500 following an epic rally for big tech in this country, pulling back 1.4% on the Nasdaq 100. Some jitters around OpenAI, informed by a story from the Wall Street Journal that they are falling short of their own internal targets. That's weighing on the equity market. This is too. Crude, Brent, WTI, Brent 7 days of gains. Just short of 112, 111.88, and up this morning by more than 3%. Triple digits on WTI. So new highs this morning, session highs for crude. At the same time, we get session highs for yields. Yields this morning, 30s. New high for the year, 496 on a closing basis if we have those levels. Twos at 384, up by 4 basis points so far today.
Stocks have been able to dance to their own music, even as you do see yields rising and you do see oil prices rising, as long as the earnings story hangs in there. And we keep talking about that. The earnings keep proving why this resilience makes sense. What happens if there's a hiccup in tech? And that ultimately is the hint that we got from this reporting about OpenAI not meeting their targets. Do we get a flavor of that in some of the earnings reports that come after the bell tomorrow?
Well, that's the story that's holding up the equity market. That's the reason we've had this massive parabolic rally off the lows of March. A move of, 18 days on chips of close to 50%, which is crazy talk, but it happened. That's the support factor. That's been the support. Now it's starting to fracture just a little bit. I wouldn't make too much of that at this point. The headwind that's coming from crude continues to build. And when I look cross-asset this morning, when you start to see crude long-dated prices make new highs, when you start to see bond yields retest the highs of the year so far, get your attention just a little bit more.
Well, because everyone's been saying this is a short-lived type of crisis, and once this ends, we can normalize and things will be okay. But, I keep going back to something Stuart Kaiser wrote over the weekend where he said that time is the catalyst here, and that the longer this goes on, you hit a tipping point where suddenly you do get supply chain disruptions that are very hard to paper over. And at what point are you looking at something that looks very different for the equity market than currently what's being priced in?
What's Brent off now? About $6 away? The front month anyway, $6 away from the closing high of the year.
Yeah, I mean, it's not very far.
And equities are 13% off the lows.
It's creeping higher, and it isn't as much of a surprise. So it's the pace of change. It isn't changing, but the changing and not changing is part of the problem. If you've got a stalemate, that the longer this goes on, the more you have a growing problem in the physical world.
Brent crude, 112, up by 3%. Let's get you some single names. Big tech factor this morning. With those morning movers, Yahara has more. Hey, Yahara.
Hi, John. We are seeing CoreWeave, Oracle, AMD, and NVIDIA all lower in the pre-market. On that Wall Street Journal report we've all been referencing this morning, that OpenAI missed some of its sales and growth targets and raising questions internally about whether it can keep up with that AI spending. And that is putting pressure on names like CoreWeave and Oracle because they're right at the center of the AI build-out and have deals with OpenAI, and AMD and NVIDIA also have massive partnerships with OpenAI on the chip side. Turning to earnings, we are seeing UPS shares now down 5% in the pre-market because even though it beat on earnings, it held its outlook steady. Compare that to FedEx, which raised its outlook last month, and you get some disappointed investors. And we end on GM. Shares are rising in the pre-market, up just 0.1% now, trimming some of its earlier gains. The driver was strong demand for its pickup trucks and SUVs, even as gas prices continue to climb, that helping to offset some weakness in its EV sales. But of course, the big question is, can it maintain that resilience in its gas-guzzling vehicles if the Iran war continues and gas prices continue to climb? John.
Yahara, thank you. Thank you for the update. Lots of stock stories out there this morning. Federal Reserve meeting kicking off later on this morning. Two-day meeting concludes tomorrow. Bloomberg's Mike McKee has a preview of what to watch. Good morning, Mike.
Yeah. Well, we're watching that guy. We'll see if he gets confirmed tomorrow by the Senate Banking Committee and then sent to the floor. He could be the chairman at the next meeting after this one. Could be Jay Powell's last one. So do they do anything to sort of mark the end and to do something about the economy? Well, there is an argument out there that they should make some kind of move. They're not going to change interest rates. We know that. There's no SEP. There is no dot plot change. But PCE inflation Thursday, we get the number for March. It's expected to be 3.5%. $100 oil, tariffs to come. Do they change this statement and say that the next move is either up or down? There's been a move towards that two-sided idea over the last couple of meetings. More and more members have been saying that. The key line to watch in the statement is this one. In considering the extent and timing of additional adjustments to the target range for the federal funds rate. That hasn't changed in some months. That's basically saying we think we're going to be cutting again, and we're just waiting to see what kind of factors push us in one direction or another, but they may get rid of that and change it to something that says we could do either one. The setup for that is they could ratify the market view that there is not going to be a cut this year, which is the way the markets are thinking right now, and especially the longer the war goes on. But it would clash with the Kevin Warsh remit from the president, cut rates as soon as possible. And since this is Powell's last meeting, what kind of guidance does he give about what the Fed's thinking going forward, and how much attention do people pay to it? So watch the statement at 2 o'clock, and then we'll listen to Jay Powell talk about that. And then, of course, we'll get into the important stuff of what's Powell going to do next.
Mike McKee, thank you, sir. Looking forward to your coverage, as always, down in Washington, D.C. One element of that jumps out for me, two-sided risk. Is this a chair that looks to anchor inflation expectations and suggest, even if they don't believe it, that the chance for a rate hike is equal to the chance for a rate cut this year?
And how much support would he have on the committee to potentially do that, given the fact that we've heard from a number of the members who are very concerned about the inflationary push and what that could mean longer term?
Would that be awkward for the incoming Fed chair to take on a more neutral situation on the committee, or is that an ideal position to take up?
He might come in and say it is two-sided risk, we're going to cut rates. And I don't have to explain it because no communication is necessary.
We're going to ban communication.
So that's what we did.
It's not a dictatorship, Bramo. It's a committee.
It is a committee, and he could talk about reshaping. Look, he's not going to do anything for a while anyway. He's gotten a clear signal from Treasury Secretary Scott
I actually think it's really important.
I do too.
Over the last month or so.
I think that might be more important.
Just some heat coming off the institution. I've heard that from Besant, from Hassett, Pirro as well. if you take that as a suggestion that they're taking down the heat a little bit.
Yeah, well, ultimately, the economy has to speak for itself. How many crises can they deal with at one time? So maybe he has some potential reprieve, at least in the short term.
Looking ahead to tomorrow, Lindsay Piegza of Stifel writing, if the Senate Banking Committee confirms Kevin Warsh on Wednesday morning, Powell could potentially announce he is stepping down at the press conference. Lindsay joins us now for more. Lindsay, good morning.
Good morning.
Is this the last meeting for Chairman Powell then?
It certainly could be. It looks like the blockage to Warsh's confirmation has been removed, and if he is confirmed on Wednesday, that means he could be sitting in that seat by the June meeting.
When he heads to the exit, Chairman Powell, what does he take with him? What changes at this institution?
Well, I think he's done a remarkable job navigating very difficult conditions. And I think that's what he takes with him, that he was able to maintain the credibility, the independence of the Fed, despite pressure from the market, despite pressure from different administrations. And I think that's all a chairman can really hope to take away from.
Do you think that he will signal two-sided risk, given the fact that oil prices are expected to remain higher for longer and the U.S. economy seems to be hanging in there?
I don't think we're going to see that specifically in the statement. And I think more than anything from the press conference, what we're going to hear from Powell is uncertainty. Like we heard last time, there were multiple times when he said, we just don't know. And I think he's going to underscore again the uncertainty that is plaguing the economy, not only because of the international conflict, but the aged nature of the recovery, where we are on this pathway. And given that, I think he's going to emphasize the need for patience. The Fed has opened the conversation to not only holding policy steady, but potentially rate hikes. But the bar is extremely high. So more than anything, Powell is going to reiterate the need for patience to understand the evolution of the data and continue to remain in this steady pace of policy for now.
As much as everyone just wants to hear uncertainty again and again and again, right. I'm sure a lot of the commentary is going to be around whether he's going to stay on as governor and what that could mean, especially given Kevin Warsh's desire to reshape the way that the Fed operates. Do you expect Fed Chair Jay Powell to want to have a say in exactly how that is, as he views himself as trying to navigate any kind of change and maintaining an independence of the Federal Reserve?
I think he would. And remember, when Warsh is talking about reshaping the Fed, what he's talking about is giving more firm guidelines in terms of the relationship between the Fed and the federal government, which he says has become perverted over the past several decades. If we go back historically, there was a firm accord that said the Fed is independent of the federal government, but more recently, that relationship has become muddied as we see this massive expansion of the Fed's balance sheet really facilitate this massive expansion of government spending. So Warsh is saying, let's go back to grassroots, go back to that traditional relationship and have a firm guideline which could help to rein in government spending and by extension then reduce the inflationary risk and potentially then lead to a lower interest rate environment. So if that is a longer term pathway, I think Chair Powell would want to be somewhat part of that. But again, it's not necessarily the traditional pathway to remain on the board once the chairmanship is over. So it remains to be seen what he sees as his longer term career pathway at the Fed.
Does remain, doesn't that in essence also create problems for Fed independence because he's breaking a precedent?
It's not unprecedented. We have seen it before. If we go back to Eccles, for example, he did stay on the board even after the chairman. Well, it's not unprecedented. It has occurred. So I don't think that questions or raises questions about the Fed's independence.
You say there's going to be a lot of uncertainty with the economy and that the Fed is facing a number of issues and catalysts. Does Powell need to come out with certainty about his future?
I don't know if that will necessarily add any certainty to the outlook for policy. I think right now what the market is looking for is a better understanding of where the Fed's focus is. We were starting to see the pendulum shift towards employment, but now with Powell coming out and acknowledging that maybe the equilibrium is at a net zero level, the focus is shifting back to inflation. And the market wants to understand how much of a concern is that for the Fed? Are we going to see policy simply hold steady? Are we going to reintroduce the whole notion of a transitory impact? Or is the Fed actively considering a reversal in the course of policy?
On Powell's future, I'm not particularly interested whether he stays on or leaves. Good for him. It's his life. It's his career. I'm sure he's earned his retirement. Go for it. If he stays, whatever. What interests me is why he would choose to stay. And the way he's framing this right now is a defense of central bank independence at a time where there seems to be no concern about central bank independence in the price of inflation expectations. I know plenty of economists are concerned. I understand why. But right now, the market's not. I hate to do either ors, but someone's wrong here. Either Chairman Powell's wrong, or inflation expectations have got this wrong. Is it one or the other?
Well, I have to say that I was a little concerned about the Warsh nomination, not because he was well known to the market, he's had his years at the Fed, but because of the change in his underlying principle. He was previously an inflation hawk. Then he began to align himself with the administration, calling for a regime change and significantly lower interest rates. But during his testimony, he didn't make the case for lower interest rates. He acknowledged the elevated level of inflation and the upside risks to inflation, also the narrow window of time that the Fed has to rein in inflation, and at the same time acknowledging that the employment picture is pretty much at full employment. So he had the opportunity to make the case for lower rates. He didn't, which suggests that he may be more of a neutral, more moderate Fed official than we're giving him credit for.
We'll see. We'll see what happens tomorrow afternoon. Lindsay, it's good to see you. Thank you.
Thank you.
Lindsay Piegza there of Stifel. Equity futures near session lows. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The UAE is officially exiting OPEC and OPEC Plus starting May 1st. The bombshell move is aimed at seizing control of the UAE's energy futures, state-run news agency WAM. Reporting the shift will allow for a gradual domestic production boost to meet surging global demand. Meta is preparing to unwind its acquisition of the AI startup Manus after China banned the transaction on national security grounds. The Wall Street Journal reporting that Beijing gave the companies a deadline of 2 weeks to fully restore Manus's Chinese assets to their original state. And key Republican senators are pushing to use federal funds for the construction of a White House ballroom. The senators are citing increased threats following Saturday's shooting at the White House Correspondents' Dinner. The construction project is expected to cost $400 million. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Ben Reitzes of Melius Research, with concerns growing over the future of OpenAI. Equity futures, negative 0.7%.
The AI narrative, the stocks did stumble, but that is very much intact. In other words, the capital spending is higher, their earnings are strong, adoption is increasing, and the expectation is that the spending on AI will broaden one way or the other. The point is that the market remains dependent on tech, and there the strength is intact.
That was Venu Krishna of Barclays on the programme a little bit earlier. We'll see if this dip gets bought, because we've got a dip this morning. Equity futures on the Nasdaq down by 1.2%. JP Morgan have said use any market weakness to add to positions. Bank of America have said fundamentals are holding up. Morgan Stanley, pullbacks are likely to be shallow. This is your pullback. There's some single names that are pulling back quite a lot in the pre-market. They're connected to this Wall Street Journal report that's indicating that OpenAI is falling short of its own growth targets. Getting caught up in that, Oracle, CoreWeave. CoreWeave actually responding to this. That stock is down in the pre-market by close to 8%, and they're pushing back.
Yeah, they're sending out an email statement coming out and saying that their business is supported by a diverse set of customers. OpenAI is a terrific partner, not the only one. Again, the emphasis being on OpenAI not being their sole business partner. We've seen this from others as well. Microsoft amending the agreement with OpenAI to be less exclusive. CoreWeave, though, much more dependent on OpenAI for a lot of the business and has been raising debt recently. I mean, this has less of a debt component, too, to finance the build-out that is tied to OpenAI demand. Again, it all goes to the question of how much is OpenAI at the center of an ecosystem that is built out incredibly rapidly to meet demand that seemed insatiable.
CoreWeave, we continue to see demand exceed supply across the ecosystem. That's the pushback from that company so far this morning. That's not the only story driving stocks lower this morning. Also this in the commodity market. Brent up for a seventh consecutive session, up by 2.6%. 111 was around 112. The oil market picking up once again. WTI briefly in triple digits, 99.60. And a bit of a headline out of the Middle East in the last hour or something on OPEC Plus, UAE heading to the exit.
After decades of being part of the cartel and a very prominent member in the group is deciding to leave. I am not shocked at all that by this decision, because this has been really a long time coming. What is a little bit more surprising, though, is they decided to make this announcement in the middle of a conflict. And I think this just goes to show how fragmented the Gulf is right now.
Is that the end of the cartel? Questions being asked.
I think it means on the margins, potentially, yes, because why won't other nations decide they also want to chart their own future? What means that Iraq and who knows, other countries, Oman, Algeria, decide, you know what, I'm done with this, I'm also going to leave.
That's the latest on crude on OPEC this morning. Our top story, the Wall Street Journal, reporting OpenAI failed to meet its own goals for new user acquisition and sales. The report fueling fears over AI spending and weighing on tech, on CoreWeave, on Oracle. Ben Reitzes of Melius Research joins us now for more. Ben, good morning, sir.
Hey, John.
Hey, it's good to see you. What was your reaction when you read that in the Journal this morning?
I thought it was a hit piece, really. It was very negative. Sam's a little polarizing to some, and it was seemed very pointed
you
to the negative.
You thought it was personal?
You never know. It was a very pointed piece that some of it wasn't even really to us new news. I mean, they have definitely slowed their user growth. That's very well known. And it was sort of glass half full, because you can't really talk about OpenAI without talking about Anthropic and some of the others, and Anthropic's crushing it. So net AI spend is through the roof, and this is probably a buy on the dip opportunity.
A buy on the dip of what this morning? CoreWeave, anything getting called up? Oracle?
Everything getting hit, really. I mean, look, Oracle doesn't generate any cash. I could see why you'd get more upset about Oracle, but I'm more focused on the chips and some of the hardware names and whatnot that can balance things throughout a bunch of clouds. I mean, I get why Oracle would be down, because they don't generate any cash and they are very levered to specific projects with OpenAI, and if they don't win, Oracle doesn't win. CoreWeave seems a little overdone because they have a very diverse customer set.
Well, at a certain point, there is a question of just how far valuations have gone. It isn't just a question of buy a dip. The dip is 2% on NVIDIA, less than that, after a $1.25 trillion rally over the past 4 weeks. It's not exactly as though we're talking about a massive dip. I mean, how do you justify that the pace of growth has been adequately reflected by how far the rally has taken us?
Well, I mean, you've got to take a step back on where we're going with AI. AI is generally an AI factory is really a software factory that tokenizes labor. You could argue that labor TAM is $60 trillion when you put white collar plus physical labor, and we're just scratching the surface on that. Now, not all labor will be replaced, but it will be augmented. The labor TAM probably goes up, and that's what we're attacking here, big picture, and we're in inning 1 of that. So this build-out needs to continue, and it will continue, and economies are in a race to do it, and there's really an arms race between the U.S. and China. So we're not slowing down just because of a negative article in the Wall Street Journal about a polarizing figure.
What would you have to see in earnings tomorrow after the bell that would make you rethink that?
Well, there's a lot of earnings, so which ones? The CapEx is really the key, is that of all the major hyperscalers, there's Microsoft, there's Amazon, there's Google, or the big three. I think I think the CapEx figure is what you got to be laser focused on, and I think that Google and Amazon may not have upside this quarter to their forecast for the year, but the one who should raise CapEx, who needs to the most, is Microsoft. They've been behind in terms of adding capacity. They have the least amount of upside to their cloud revenues, and they also have to train a brand new frontier model that they're working on because their OpenAI partnership isn't working out, because OpenAI wants to go it alone. And so that'll be interesting. But I think in general, the CapEx news will be positive, and that the hyperscalers will articulate a vision that AI has a payoff coming down the line, and we should see huge upside coming to the clouds, especially at Google and Amazon, because they have the capacity.
It's not a good week for OpenAI. I know you don't particularly like the Wall Street Journal story, but also he'll be in court. And he's getting sued by Elon Musk, who's all over Twitter calling him Scam Altman. Do you think any of this is going to hurt their IPO prospect?
Doesn't help, but you'd like to have a positive narrative coming out. I mean, you've seen the CFO all over. She's been doing a lot of public appearances. But they just put out a great model. I think, look, there are these articles and these narratives, blah, blah. But at the end of the day, they put out a great model. The model is very capable. Their coding revenue is growing. We need to know how much. And we need to know how much the mix is shifting towards enterprise from consumer. And if enterprises are willing to adopt them versus Claude, or even both, and how that's going. And we need to also see what the gross margin projections are going to look like. So there's a better narrative around Anthropic these days in general because of their enterprise focus, because there just seems to be more anecdotal stories about, wow, I adopted Claude, and oh my God, my work has gotten so much better and all that. And there's definitely a lot more of that. But there's a very capable model that just came out from OpenAI and Spud. And it's awesome, and we'll see. And NVIDIA trained that thing, and we'll have to see how it goes. Sometimes the models, tell the story, not the media.
Ben, it's good to see you.
Yeah, great
Appreciate
to see you guys.
Thank you. Ben Reitzes there of Melius Research. The PR around one company is a little bit better than the other at the moment.
Well, yeah, Anthropic's had better PR, and this certainly was underpinning this recent article. Can Spud change everything? Spud versus Claude. I can just imagine the Super Bowl advertisement.
We'll see. Big afternoon coming up tomorrow afternoon. Tons of earnings. We'll break things down with George Goncalves of MUFG. Angelo Zeno of CFRA will speak to the Ocean First CEO, Krishna, and the former Kansas City Fed President, Esther George, heading into tomorrow afternoon's Fed decision. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.